The fiscal situation is a real mess. The spending is out of control.
Direction of travel when it comes to the fiscal discussion is only one way, namely that we will see debt levels go up.
I think the bond vigilantes are awake.
The bond vigilantes have to get the attention of the politicians.
The turbulence may go on for years and years, by the way, but we first have to see how the fiscal drama plays out in Washington.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday as a tax bill fight brews in Washington.
Are Republicans still grandstanding in your view?
Oh, yeah, sure. You have a couple who will grandstand, but I think even the grandstanders should. Look, the alternative is a 68% tax increase. You can blame the Democrats for that and one or two grandstanders. So this is the biggest tax cut in the history of our country. Or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast.
The president growing frustrated with demands on Capitol Hill, urging Republicans from high-tax states not to derail his tax bill. Lawmakers from New York, New Jersey and California digging in, but Speaker Johnson is sticking with his Memorial Day deadline.
As a reminder, we're right on schedule. Our House Budget Resolution gave instructions to 11 separate committees in the House to write their portions of the budget reconciliation bill, and they did it right on target. We never thought this was going to be an effortless process, because when you're doing this much in a bill this large and complicated and comprehensive, there's a lot of opinions in the room.
That deadline is just days away.
And it is the concentration of this market, and it is remarkable to the extent that it is. You can even get reports overnight that Israel is considering striking in Iran. And what happens, John? It is a flee away from duration. It is that considerate concern that there's going to be a growing U.S. deficit that is mounting. Growth is slowing. So it makes Treasuries to look more difficult as a haven as D.C. really tries to figure this out.
Check out the long end of the curve this morning. We're up by 5 basis points and back through 5% on a 30-year maturity. The 30-year yield this morning at 5.02%. A question we keep returning to on Bloomberg Surveillance. What is going to constrain this tax bill down in Washington? The fiscal hawks or this bond market?
The thing about this bond market, though, is this has been a very orderly sell-off. This is not something that many people have called for what you need, which is, I'm sure she doesn't like this, but a Liz Truss moment. Instead, it is a slow creep higher in 30-year yields, and it seems to imply that this repricing could be more sustainable and more durable than what we saw in April, and less reactive to D.C. because it is a slow inch higher.
It's fair to say that Liz Truss hates it. Yields are up. Equities are down. Equity futures on the S&P negative by 0.8%. Coming up this hour, we'll catch up with Tchir of Academy Securities as stocks snap a 6-day winning streak. Sucharita Kodali of Forrester reacting to earnings from Target. And Dan Ives of Wedbush on Elon Musk's recommitment to Tesla. We begin this hour with our top story. House Republicans looking to strike a tax deal on Capitol Hill. Joining us now, the Bloomberg team, Annmarie and Tyler Kendall. AMH, first of all to you. You're catching up with Speaker Johnson later on this morning. How high are the hurdles to get this done next Monday?
It's a really big day for Speaker Johnson because we should note the amendments that he agreed upon all day long and all evening long into the early hours are still being discussed in the Rules Committee. So these amendments, this bill is making its way through the Rules Committee right now. It started at 1 o'clock in the morning, and we don't even have the text yet to confirm what was discussed. So this is a really important day for Speaker Johnson. First question, can it get through the Rules Committee? And then, of course, how soon could he get it on the House floor to meet his self-imposed Memorial Day deadline? We will see what he has to say in the 9 o'clock hour when he sits down with me here in Washington, D.C. But, Jonathan, 2 big changes per reports were discussed. And this is potentially able to get the entire Republican conference together to vote for this. One is the SALT cap. This is really important for high-tax states like California, New Jersey, and New York. You've heard that before. I know you've spoken a lot with Representative Mike Lawler. So what was agreed upon was lifting of the SALT cap from $10,000K to $40,000K for those making less than $500,000. Now, there's also something else in there potentially for conservatives. We do expect potentially the carve out, the rescission of these credits for green technology, those grants. That might happen sooner than it was expected to be. So maybe as soon as 2028. So that would be a carrot for those conservatives to be able to sign up for this. But we should note this is going to be a long slog today on whether or not this bill gets to the House floor.
Tyler, the president went to Capitol Hill to rally the troops to herd the cats. What went wrong?
Yeah, hey, John, good morning. Well, President Trump did come with this message trying to pressure these lawmakers to reach a deal. But at the end of the day, afterwards, many said that they weren't going to budge unless they saw some changes to how the deal stands. Now, it's our understanding that President Trump singled out those two factions that Annmarie is talking about, those so-called SALT Republicans and also those fiscal hawks. In fact, I had the chance to catch up with one of them, Congressman Mike Lawler, a Republican from New York, who told me that he made his case directly to President Trump that so far the proposals had been inadequate. I spoke to many Republicans as they were coming out of the meeting, and the message seemed to be stop messing around. That was a direct quote from Dusty Johnson, one of the Republicans that is trying to urge them to come together on a deal. At this point, we're really going to have to see if these changes that Annmarie was outlining is going to be enough to get this over the finish line. Because, John, after President Trump left Capitol Hill yesterday, Speaker Johnson made his way over to the Senate, considered to be an unusual move, but it is clear that he is working with this administration to try to grease the skids that once it gets through the House, and when it gets through the House, they're going to also face an uphill battle when it comes to the upper chamber.
Tyler, Annmarie, thank you. The negotiations continue down in Washington, D.C. Here's the view from Wall Street this morning. Tchir of Academy Securities writing, Budget 2026 will be a crucial stepping stone. It may not be smooth sailing. There's potential for friction domestically that may impact markets negatively from here. Pete joins us now for more. Pete, good morning. Good to see you.
Good morning.
Is Congress picking a fight with this bond market?
I think Congress is trying to do the right thing and get this budget passed. I think, unfortunately, DOGE wasn't quite as successful as we thought, so the deficit's going to go up. But I think they have to power through this. But there is this immense amount of friction. I go back to the University of Michigan surveys where you've never seen such discrepancies between what Republicans think about the economy and what Democrats think about the economy. So it's going to be a struggle to get this through. Hopefully they get something through that's reasonable and that we can move on with. That was kind of, I think, what Trump was brought in to do, is growth. This kind of is the first thing that we've seen that's truly growth for a while, so let's get this through.
Do you think it's good or bad if we do get it through? For markets, thinking across stocks and bonds?
I think it's probably not great for bonds. I think we could see a little bit higher yield. But from there, I think it's probably fine for stocks, right? This is the first stepping stone. And part of it, it's a disaster if we don't get anything through, right? Because the big problem, I think, with this is it's extension of existing tax cuts. So if those disappear in some way, shape, or form, that's just awful because no one's behaving as though they're coming off. So a lot of this deficit's going to be increased, but it's not going to get the full bulk of it coming into the market because it's only the incremental increases, I think, that will create new spending power.
Why is it good for stocks when the first time around, when we had a similar debate in Trump 1.0, when you had tax cuts that were supposed to juice the markets, you got 10-year yields to 3.25%. That was enough to spook equity markets. We're at 4.45% now. Why isn't that enough to spook equity markets?
Well, I think last time we ran up heavily right into the actual tax bill getting passed, so there was a lot of sell the news. I don't think we've had quite that same run up. I think we've had the run up much more because of tariffs. But again, we've had, I think in the last 2 weeks, we've been talking a lot. The Trump put is clearly back on the table, and Trump pivot has been very helpful to markets. So there is some risk if yields go higher. My biggest concern on the yield side is the basis trade, which supposedly was a big part of why yields went higher back in April. That got reset. I think one of the problems whenever we get sort of intervention is those trades get reset and people get very comfortable. Hey, if they're going to intervene, I can put this trade back on. So the stops will be higher. But I'm concerned if you start getting to 5.10, 5.15 on 30 years, it can accelerate quickly because that basis trade unwinds again.
So to be clear, is there some real market fragility you're worried about at this moment?
Yeah, I'm not in panic mode, but I do think bond yields could push higher. So I think structurally we should be lower. I think right now the technicals are pushing for higher yields.
Structurally we should be lower. What do you mean by that?
That I think when you look at the state of the economy, it's not doing great. It's okay, but I think the backing off of tariffs actually gives Powell some ammunition to cut rates if he chooses to later this year. I think the employment data has been a little bit goosed in how it's calculated with the birth-death model. You're not seeing that through a lot of other statistics. So, and inflation as a whole, away from what's going on with tariffs, had been coming under control. So I think we should be more at 4.25 on 10s, but I think that's at the bottom end of my range because of the technical.
Just to follow up, isn't that the concern, that there are economic reasons for yields to be lower, but they're not? Isn't that the problem here? And isn't that raising the question about what is happening and whether there is a buyer's strike starting to develop?
I do think you go through these ebbs and flows, right? So everyone got very bullish 10s. Oh, this is going down. Everyone believed in investment. Hey, we can get to, 3% on 10s. So the positioning's bad. I think that's pushing. And the Moody's thing, I think it just really triggered everyone's reminder, hey, this deficit's real. We're not accomplishing what we thought. And globally, though, there's a buyer strike. That's the interesting thing to me, right? It's not just U.S. yields are going higher. Across the globe right now, you're seeing yields go higher.
Well, that's the question, though. If not the U.S., where do you go? Where do you go? You can't buy Japanese duration right now after horrible auctions and continued pressure there. So where would you go if not the U.S.?
So I think you want to be at the shorter end of the curve right now because there's so much uncertainty what's going on. I do think you have these risks, these basis trades unwinding. Japan's no longer the cheap, the carry trade could be at some risk. I do think the one thing you're seeing is investors in each country moving a little bit more towards their own currency. So if you're in Japan now, you buy yen bonds. If you're in Europe, you either buy bunds or something else. So I think treasuries are going to be most affected by a demand for local debt, moving away from the dollars, not jumping through all these hoops. Because again, you look at 10-year in Japan, 1.5%. It's been a long, long time since anyone in Japan could get any sort of yield without having to jump through all sorts of hoops, buy dollars, bonds, and swap them out. So I think that you kind of have the separation.
I'm calling this the great repatriation. We'll see if it catches on. What I'm trying to figure out is whether it's the consequence of pull dynamics or push dynamics. Which force is dominating here? Better policies elsewhere, or is it policies in the US pushing capital out?
So I'm kind of looking at it three different ways. So on the treasury market or the risk-free, I think people are kind of pulling back to their own markets. I think in credit, that's going to be very limited ability to do that, right? If you want to be a diversified credit portfolio, you need to buy U.S. credit because, one, we have many more sectors. You've got much more, in terms of rating, breadth and maturity breadth. So I think U.S. credit's going to be better protected than the treasuries. And I think U.S. equities are really going to be fairly well protected, partly because, it's kind of a misnomer to call it U.S. equities, right? 40% of the earnings are, the S&P 500 is full of giant global companies. So I don't think people can pull out as U.S. equities as much, just because they really aren't U.S. equities. I think the Russell 2000 maybe people could avoid. You're going to be in the NASDAQ 100. You're going to be in the S&P 500 if you're even a foreign investor, because these are big global companies. You need exposure to them.
Pete, this is great. You're going to stick with us. Peter Tchir there of Academy. Equities down this morning by 0.8% on the S&P. Bond yields higher at 5 basis points to the long end. Your 30-year yield this morning at 5.02%. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. House lawmakers are debating President Donald Trump's tax bill through the night. The hearing started at 1 a.m. Eastern. Key points of contention include expanding the SALT deduction and curbing spending on Medicaid benefits, plus clean energy credits. Lawmakers hope to meet a self-imposed deadline to approve the legislation by tomorrow. Meanwhile, President Trump says a missile defense shield called Golden Dome will be operational by the end of his term. He says it may cost $175 billion, but the Congressional Budget Office says the bill could reach $542 billion over 20 years. Trump has appointed a Space Force general to oversee development and says Canada also wants to be part of the program. Meanwhile, UK inflation accelerated more than expected to 3.5% last month, its highest rate in more than a year. The increase was driven by increases in energy, water, and other administered prices. Traders slashed bets on further interest rate cuts, favoring just one more quarter-point reduction by the end of the year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, pressure building in Washington.
So this is the biggest tax cut in the history of our country. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse.
Up next on the program, we'll head down to the nation's capital and catch up with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Snap at a 6-day winning run on the S&P 500 this morning, negative, down just a little bit softer. We're off by, let's call it 0.8% on the S&P, on the NASDAQ down by 0.9. Check out the bond market, yields up again. Hello 5%, hello again. Your 30-year yield up by 5 basis points, 5.02% on a 30-year. Under surveillance this morning, pressure building in Washington.
So this is the biggest tax cut in the history of our country. or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse. I'm a cheerleader for this party, and I'm a cheerleader for the country. Much more importantly for the country.
So here's the latest this morning. A key House committee convening on President Trump's tax bill after his trip to Capitol Hill failed to convince some Republican holdouts. Annmarie has the latest from Washington. Hey, Annmarie.
Well, Jonathan, lawmakers on Capitol Hill have been working through the night, through this Rules Committee, this hearing. The first panel of this hearing wrapped up at 4:30 in the morning. So you can just expect how long this may drag out. It's going to be a slog. But we do know behind the scenes there were some deals cut. And for some more insight on that, we want to bring in Terry Haines of Pangaea Policy. Terry, you've seen the reporting, I'm sure, and I'm sure you have a little bit more insight. What do you make of the deal cut when it comes to salt, as well as pulling back some of those clean energy investments? Is that going to be enough to satisfy some of the naysayers?
Good morning, and I think it probably is. Yeah, the salt deduction, of course, has been talked about quite a bit, so I won't reiterate. But it sounds like that deal is going to be enough. And as you pointed out earlier, we haven't seen it papered yet, so that may take a little bit of time. And the green energy phase outs also are things that Republicans have been interested in for quite some time, and so I imagine the combination of that is going to be enough. But Johnson will use the Memorial Day recess, kind of as a hard backstop. This is kind of standard procedure on the Hill and in the House, particularly a hard backstop to get people to put up or shut up. And I expect he'll have enough votes at the end of the day.
Of course, Congress needs a deadline in order to really get something done, Terry. But even if Johnson is able to get this through the House floor, give our audience a sense of how difficult this is going to be when this bill goes to the Senate. Does it even look recognizable when it comes back to the House?
Well, it's going to look different than the House, certainly. Speaker Johnson went to the Senate yesterday and begged them to keep it as close to the House version as possible, and I'm sure that fell on deaf ears. The thing you got to understand is that the Senate is, the House is a kind of very majoritarian sort of body. The Senate is much more collaborative. Think of these folks. Since they only need Republican votes, think of them as 53 CEOs all negotiating with each other, and that's what you're going to get. You're going to see a very different Senate bill. It's going to take weeks, and at the end of that process, I think what you see is in Capitol Hill parlance, you see the Senate trying to jam the House. In other words, the Senate will do its bill, say take it or leave it, and then what's going to happen is the House is going to have to be herded again in order to make this happen, more on the Senate's terms than the House. That's really where Trump comes in right at the end.
So what happens on the Senate terms when it comes to SALT, Medicaid, and the clean energy tax cuts?
I imagine that SALT will still be fairly generous. I imagine Medicaid gets softened at the edges. They're hardening up work requirements and some other things in order to get House conservative votes on Medicaid. I imagine that gets softened again. And on green energy, I imagine again it probably gets extended a little bit. The net effect of all three of those, frankly, are things that are politically more palatable, but may have the effect of nudging around the debt and deficit problem even further.
And you think this can get done by July 4th? How?
I think it's certainly possible. Firstly, you need a political imperative, which is a fancy way of saying that you need Trump, the executive branch, to kind of light a fire under the Senate, not let the momentum that's been built up by the House dissipate. Secondly, you need that to happen in the Senate leadership as well, and I think it probably does. Thirdly, now that the Senate's got a template from which to work, what you will see senators of all stripes on the Republican side, the only side that matters in this unique process, coming out and actually, giving their own red lines. So you begin to assemble a coalition of 53 Republican senators, not unlike the herding that you've seen in the House.
Terry, if this doesn't get done, what kind of tax increases could we see going into next year?
Well, if it doesn't get done, then you've got your bumper. You had Trump on the bumper there saying you're going to have essentially a snapback to pre-17 tax law. So that's for people that are used to the current situation, that's a huge increase. I have 68% in my head because that's what the president said. It may not be exactly that, but it'd be something fairly large. So, the kind of the looming economic undertow here is worth remembering as well, and that creates its own sort of urgency. The other thing about the July 4th deadline that I want to mention is there are basically three kinds of things coming together. It's not just the tax bill. It's also that reciprocal tariffs are being studied, and there will be a report out on that. And I would look at that as a deadline for a lot of these trade deals that are being negotiated as well. So you have the opportunity to either have a substantial lift coming out of Washington economically, or substantial downturn, either way, frankly, politically.
Terry, the bond market this morning on the long end, we do see yields once again higher. Interest on the debt is currently the fastest growing part of the U.S. budget. If they get this deal done, how are they going to deal with the deficit after this?
Well, they're not going to deal with it in this bill, as you know, and there's an expectation by some who don't understand the process, and people shouldn't necessarily, but that this bill will wrap up all problems, and that'll be the end of it, and that's not the case. I think what you'll hear going forward is a lot more from Secretary Bessent about his 3-3-3 idea, the idea that now what we're going to do is we've dealt with the taxes, we've dealt with manufacturing, we're dealing with trade in a separate track. Now we're going to turn our attention to spending discipline. So what you're going to see in the first instance, I think, is you're going to see huge fights, months-long fights, frankly, over spending in the fall, not just because Republicans want to show some fiscal discipline, but because Democrats also want to resist a lot of the things that Republicans want to prioritize on spending discipline. And they look at that opportunity for spending in the fall as a means of revivifying their brand, frankly, which is not in a good place.
Terry, thanks so much for your insight this morning. Jonathan, Terry Haines there, of course, of Pangaea Policy. Two things. They won't address the deficit in this bill. We know that, but maybe the fall, the bond market will start to wake up Congress a bit. And then, Jonathan, he thinks 80% chance the one big beautiful bill, which he also calls the 1-3B, gets done by July 4th.
Annmarie with the latest down in Washington, here in New York City. Danny Berger alongside us this morning. Peter Tchir still with us as well. Pete, I want to come to you on the bond market. Yields up across the curve here. We're up by 5 basis points on a 30-year, back through 5%. Is there a level at which you believe would force corrective action in Washington? And what does corrective action actually look like?
I think they're going to make sure the bond market's trading orderly, and so far it's been very orderly. I think it's very difficult for them to do anything, whether it's QE, maybe some sort of Operation Twist to try and help at the long end of the yield curve. But I think, quite frankly, we need to see the data come in that allows the Fed maybe to do something. Other than that, I think this runs its course, unfortunately.
Are we likely to see that data this summer?
I feel we are. I think in the next few months, we're going to start seeing more and more weakness in the job market. I think we're seeing a bit in retail sales. I'm more and more concerned about what you're seeing in terms of delinquencies rising. You're hearing a little bit more about buy now, pay later struggles. So I think the consumer's just about tapped out. So you're slowing there. And everyone you talk to, I think there's just so much political uncertainty that no matter what you want to do as a business, you have to act slightly conservative. So I think that hits the data until we kind of get some clarity on where we're really going to be on tariffs and things longer term. And I think we're months away from even getting a glimpse of that.
September is what the Federal Reserve, Danny, told us earlier this week. Wait until September.
Yeah, but how distorted is the data going to be in the meantime? As everybody rushes to get shipping in, who's to say even in September it'll be a clear picture?
Another data point on the economy coming up. We get earnings from Target in just a moment. We'll break those earnings down with Sucharita Kodali of Forrester. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Here's a flavour of the price action for you. Equity futures lower this morning, down by 0.9% on the S&P. Similar move on the Nasdaq 100 as well. Earnings from Target dropping any moment from now. Before we get to that, let's get you some movers in the pre-market. 3 hours away from your opening bell with Yahara. Hey, Yahara.
Hi, John. We start with the latest retail earnings that just came in, and that is low. Shares are higher 2.7%. They did have solid results. Comparable sales did dip in the latest quarter, but not by as much as what was expected. Plus, it boosted its full-year comparable sales forecast. So what Lowe's is telling us here is that shoppers continue to flock to its stores for its home products despite all the noise we've been hearing around the economy. Next up, staying in the home space, we have Toll Brothers. Those shares are up more than 5% here. The results were mixed for the luxury home builder because while demand was soft in the latest quarter, it did beat on the bottom line. Plus, it also stuck to its full-year guidance. CEO Douglas Yearly pointing to fierce demand for new homes amid limited supply. We've heard that before. Plus, a high-end market that he says shows no signs of cooling. And last up, we have a downer. Wolfspeed absolutely plunging here, down 55%, as the Wall Street Journal is reporting the company, which makes chip components, is preparing to file for bankruptcy within weeks. Not only has it been struggling with a high debt load, but it's also faced weak demand from the auto sector, and it's been caught up in all this tariffs uncertainty. So Wolfspeed is expected to file for Chapter 11, according to the Wall Street Journal, with backing from most of its creditors. John?
Yahara, thank you. Appreciate it. Here's another mover, Target. The numbers just dropping. The numbers aren't great. It's a miss on sales and a cut to the outlook. They now see full-year sales declining by low single-digit. They had previously seen growth. That stock is down in the pre-market by 1.65%. Not great numbers from Target this morning, Danny.
It's really not, and it's interesting to look at what the CEO is blaming this on. He talked about multiple things: discretionary weakness, declining consumer confidence, uncertainty over tariffs. But John, I'm not sure how much you can blame that in this current environment for the current results. When you see the likes of Walmart still posting strong reports, Home Depot, Yahira was just talking about Lowe's. So I think you're going to have in this moment companies using the uncertainty among consumers as a catch-all, but can you really do that in this moment?
You need to be super agile in this moment. It's interesting they're establishing a multi-year enterprise acceleration office, and the office is to drive even greater speed and agility across the office, the company.
It's what we've heard of these various companies putting together task force, trying to figure out how they right-size their supply chain. It is a moment we hear again and again of uncertainty. How much are they thinking about what they need to do with their stockpiling? How much are they pulling things forward at this moment with a target that's especially difficult if demand is really low? Do you really want to load up the boat and get all of your products into store now?
We'll come back to that company in just a moment. Target reporting earnings just moments ago, cutting their outlook and sales coming in lighter than expected. On our radar this morning, elsewhere, President Trump's big, beautiful tax bill hitting a stalemate in Washington. Sources telling us here at Bloomberg that Trump is growing frustrated about calls for raising the SALT cap. Elsewhere, G7 finance chiefs gathering in Canada. Canada's finance minister saying leaders are discussing tariffs on oversupplied and low-value Chinese products, adding that talks would include how countries can coordinate to curb Chinese oversupply.
It's not a surprise at all, because this is something which many countries had fear, that you get rid of the de minimis rule in the U.S., where do the cheap Chinese goods go? They need to go somewhere. We've seen again and again in the data in China that exports are so crucial to them. This is something the EU had been grappling with 2 years ago. They had thought about also removing their de minimis rule, but you needed the action from the U.S. to really prompt this from the G7 nations. So we're finally starting to get movement there, but what happens in the meantime? What degree do we see cheap goods flooding these markets?
Peter Tchir still with us. Pete, isn't this precisely, almost exactly what the U.S. has been calling for years now?
Yeah, and I think the other flip side of it has been we've been talking about China's only way out of their own economic morass is to export their own brands, right? So we've been calling this shift from made in China to made by China. So I think they're going to continue to push that, and they are going to look to Europe. More and more, though, it's really the emerging markets that I think they're really trying to push into. That's where they've got these ties with the autocratic, resource-rich nations. China's importing a lot of raw material. They are trying to export their brands. I think that's their only hope. They're trying to push this. This is a setback to them. I don't know how successful we'll be on pushing back on them, but that to me has been the big concern is China trying to sell their brands globally and compete with our brands globally. This will put a dent into that, but it's still their long-term strategy, and I'm not sure how willing we are to live with this for very long.
Pete, since you're with us, I wanted to turn to this story as well. The CNN report that Danny mentioned about 30 minutes ago, that Israel is preparing to strike Iran's nuclear facilities. US officials saying it's unclear if Israel would ultimately carry out the attacks, and a final decision has not yet been made. Your company, as we often say, is full of generals. What are they telling you about the situation in the Middle East regarding this?
Yeah, so this is something we talk about a fair bit, and I'm lucky enough to work with 30 retired generals and admirals, and we do a lot of red team, blue team, so you try and play these things out. I think the consensus is it would be very, very difficult, if not impossible, for Israel to do this without direct support from the U.S. They really need our equipment. They need our things. The other thing that concerns me a little bit is, Ben, I think they look like the odd man out on this recent trip, right? When Trump was in the Middle East, he really did not do anything to Israel. And then the final part of this is maybe everyone's now just learned this maximum leverage thing. So you say the utmost aggressive thing possible to bring people to the table. And I think that's unfortunately becoming a, status quo in the world right now, is everyone's read Art of the Deal, and everyone now knows you just say the most outlandish thing or most aggressive thing and see what people do.
Well, that's the thing. The background of this at the moment was the U.S. and Trump being very clear that they wanted some sort of agreement with Iran, with nuclear talks. I think it was really interesting that this report suggested that it came from U.S. intelligence sources, not Israeli. Is there a sense to which this is the U.S. saying, hey, we are not involved in this. We are trying to warn you to some extent in order to make sure that some sort of talks can still be ongoing?
Well, I think some of this is still even going back to the Biden administration, where we tried to tell Israel how to prosecute the war. And I think if you look at this from an Israel standpoint, they have Hamas back on their heels. They have Iran back on their heels. They've demonstrated this ability, and they are horrified that one day Iran becomes a nuclear power, and that whatever's put in place, they get this. So I think from an Israel standpoint, you can kind of see that they're saying this might be our one chance to truly stop this and nip this in the bud. And that's not suiting our agenda. It's not suiting what the rest of the Middle East wants. So I can see there's some tension. And maybe, again, this is just a negotiating ploy for Israel to get some attention from the U.S. and get something they want.
Well, to that point, Pete, do you think these extreme headlines that have built up repeatedly over the last month have begun to have a dampening effect on price action? The fact that crude is up by not even $1 this morning off the back of this kind of speaks to that.
Yeah, I think we're all learning whatever people say is now just the starting point of some sort of negotiation. Everyone's kind of playing the same sort of game. It's a scary one because you're not quite sure what will happen. We went from India and Pakistan to relatively, calmish neighbors to everyone talking about the risk of nuclear war back to calm very quickly. So I think those things were overstated. So I think we are dealing with that. But the risk is that we become too complacent and one of these things sneaks through and all of a sudden we just went somewhere we did not think was possible.
And 60 is not the right price for crude at that point.
No, not
happens.
at all.
WTI right now, 62.61. Brent crude, 65.94. That's the situation in the commodity market. Let's turn back to Target. The retailer reporting a miss on sales and cutting its outlook. Sucharita Kodali of Forrester joins us now for more. Sucharita, welcome back to the programme. I just want your opinion on Target first. Is this a Target problem or a retail problem?
Well, it's both. Virtually every retailer, with lows accepted this morning, has really expected struggles in the year to come. We saw that with the Walmart announcement. Lots of questions around what is the impact, of course, of tariffs and the uncertainty in the economy. And Target is not immune to any of those concerns. Target also has had serious execution issues. While Walmart stock has been doing pretty well, Target's at more than a 5-year low. So that really suggests, and it has been for several months now, which suggests that there are serious execution issues and store operations issues that need to be dealt with even outside of everything related to the economy and tariffs.
But they're not in a vacuum, Sucharita. They do have to deal with what's happening with the economy and tariffs. How much more difficult or how much more does it delay their timeline for right-sizing, for getting those operational issues fixed, when they are potentially dealing with some serious demand loss because of what's happening in the economy?
Right. It is absolutely a perfect storm in many ways for them, because they certainly have their own internal issues. In addition to the numbers that they released today, there were a lot of personnel changes that they announced. Who's going to head this new committee to rejuvenate the company, merchandising changes. So lots of shift at the leadership level that will be attempted. But at the same time, to do that in the face of not knowing what the price of products may even be in the next 6 to 12 months during critical time periods like Q4 is going to be an additional challenge. And they don't have as diverse of they don't have as much success with .com, although the .com comps were decent. They're not as heavily invested in it as Walmart. Their retail media business, which is a profit pool that could potentially offset things, is not nearly as large as Walmart's or Amazon's. So it absolutely is a challenge that they are going to struggle to overcome in the coming year.
When it comes to these retailers trying to figure out their supply chains, Home Depot, I thought, was really fascinating yesterday, Sucharita. They said at the moment it sources about 50% of its products in the U.S., but it said over the next 12 months, it expects that products coming from outside the U.S. will be no more than 10%. Sucharita, how realistic is that, not just for Home Depot, but some of these other retailers to try to do something similar?
Well, I think that what we're seeing is a lot of announcements to try to lend confidence to the markets that supply chain issues won't be as much of a factor, at least in terms of the receipt of goods. Whether or not that actually happens, I think remains to be seen. There is so much that needs to go into shifting suppliers from even one market to another. You have to deal with so many issues related to compliance. Some of the things that retailers are telling me is that, candidly, it's very difficult to shift out of some of those East Asian markets because the factories often are very good with the compliance laws around just ensuring that the products they meet the standards of wherever they're being exported to. And often the U.S. does have some of those higher import standards that those factories are uniquely suited to address. But the other issue, though, is what concerns me about the Home Depot announcement is when you say that it's only going to be 10% that's going to come from overseas, I worry about inflation because that to me suggests that prices are likely going to go up.
Sucharita, we've got to leave it there. What a difficult moment for retailers. Sucharita Kodali there of Forrester. If you're just joining us, welcome to the programme. Target out with numbers, much weaker than expected, and a cut to the outlook as well. The stock is down by 1.7% in the pre-market. Pete, I just wanted a final word from you, sir. There's a word that we hate on this programme, idiosyncratic. And whenever you get numbers like this from a retailer, we can say it's unique, it's retailer specific, it's about target, not about the sector or the economy, the consumer. How are you getting a clean read on the consumer in America right now?
It's really difficult. I think you're trying to look at things like delinquencies, et cetera, and it feels like the top end of the consumer is still doing quite well. The lower end is not doing so well, and you're trying to figure out which way is bleeding more. Is it going to bleed down? I think it's a little bit fragile out there. I think, getting this big, beautiful bill will help with confidence. I'm a little bit concerned, and for the first time, too, I'm starting to look at, does it matter if you're in a red state or blue state? Again, I keep coming back to when you look at anything in this economy and you do any sort of subjective data, Republicans are saying it's great, Democrats are saying it's awful, and I'm not sure if that means differences for your stores, for where you're selling things. I feel like it's pervasive, though, and it's just an extra layer of getting difficult things to read through. I think the economy is weakening. I think it was weakening before all this. I don't think it's going to be great.
I think it's safe to say that you, Mitch, is more of a political poll than it is an economic survey at the moment.
Well, if you have some surveys of the Democrats and you, Mitch, expecting 11% inflation, and you've had readings of nearly 0% for Republicans, I think, you can make that assumption.
Pete, we've got to leave it there. Good to see you, sir. Peter Tchir of Academy Securities with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Recapping those Target earnings, shares are lower by 0.3% after Target cut its sales forecast following a weaker than expected quarter. The CEO citing weak discretionary spending, tariff uncertainty, as well as backlash after the company dropped diversity initiatives. However, e-commerce and same-day deliveries were a bright spot for the retailer. Meanwhile, Lowe's shares are rising in the pre-market. They're up 2.6%. The home improvement retailer reported comparable sales that dipped 1.7% in the first quarter, but that was better than what analysts were expecting. Lowe's also maintained its guidance for the full year. The results showing shoppers maintained home spending despite weakening consumer sentiment. And UK Chancellor Rachel Reeves and U.S. Treasury Secretary Scott Bessent are set to meet this week on the sidelines of the G7 finance ministers meeting in Canada. The two will work on finalizing the details of a trade deal announced earlier this month, including carve-outs for Britain's auto and steel industries. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next, recommitting to Tesla.
Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all?
Well, no, I might die.
That's one way of putting it. Dan Ives of Wedbush joins us next. Live from New York City, this is Bloomberg. Snapped a 6-day winning streak on the S&P in yesterday's session. Over those 6 days, up by more than 5%. Yesterday, down about 0.4%. So a tiny correction. This morning, we're down by 0.75% on the S&P. On the Nasdaq, we're down by 0.75% also. Keep one eye on the bond market as always. Check out the long end of the curve. Yields up, the curve steeper, up 6 basis points on 30s, 5.02%. These are the kind of levels we've been in and around, Danny, over the past few sessions. We've struggled to close here. This is the level to watch.
Yeah, no one seems to want to be a buyer around 5%, but there has been a lot of chop in equity markets, a lot of chop elsewhere, except for the long end of the curve. And again, I think this is so notable that April, you had this big surge upwards in yields. It comes down. It has been a very, very easy trend in May that it's orderly, you keep moving higher. Does that suggest that this has more durability than what we saw in April? And that, I think, will be concerning, not least to market participants, but also to what's happening in Washington, D.C.
Yields up and the dollar weaker. That's what spooks people. Yields up this morning. The dollar weaker against the euro. Euro dollar 113.47. Under surveillance this morning, recommitting to Tesla.
Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all.
Well, no, I might die.
I wonder if some of what has happened to Tesla in the last few months, did you take it personally?
Yes. In terms of political spending, I'm going to do a lot less in the future.
And why is that?
I think I've done enough.
So here's the latest this morning. The Tesla CEO, Elon Musk, doubling down on his commitment to the EV maker and pulling back from politics. Bloomberg's Craig Trudell joins us now for more. Craig, great that he's recommitting. He is that company, without a doubt. He is the success that company has had over the last decade or so. Craig, as he goes back, what is the problem, the number one issue he's got to fix?
I think one of them, just based on yesterday's conversation, is maybe looking at the state of Tesla a little bit more clearly, because it is not turned around as Musk suggested yesterday, and one needs to look no further than I would say particularly the state of their sales here in Europe. I think for Musk to suggest yesterday that there are no exceptions, everybody in Europe is having a hard go of it. It's just, false. And, until and unless there's an acknowledgement, that they have a problem, it's hard to wrap one's, mind around or get comfortable with the notion that they are going to set out to fix that problem. I also think, the way that he spoke about, sort of people in opposition to Tesla is unlikely to, endear or sort of mend fences when, he talked yesterday about the idea of, if those of you attacking my company, we're going to come after you. That wasn't the sort of tone that you would maybe hope to hear if you want to see him kind of change the way he's going about, presenting himself to the public and potential car buyers.
Craig Trudell out of London. Craig, appreciate the update. I want to turn to a Tesla bull, Dan Ives of Wedbush, who has an outperform rating on the shares and a 350 price target. Dan, do they have an operational problem or a reputational issue? And how easy is it going to be to fix?
I think it's a big step forward that we saw from the earnings call, from the Musk recommitting to Tesla. And I think these interviews that we saw yesterday, it's another huge step forward, because to me, you're talking about with NVIDIA, two of the biggest disruptive technology players in the world in terms of autonomous and Optimus. So I view it, is there some brand damage? We've said there is. But I don't view it as something that it really changes the game going forward. And I think now demand starts to rebound in Europe, demand starts to rebound in China, and Musk is Tesla, Tesla is Musk. Tesla got back its biggest asset, doubling down here.
So, Dan, does that mean when Elon Musk said yesterday as to how he would turn around the company, and he said, it's already turned around, that you would agree with that?
I would. I mean, look, we've talked about on the show. It was a dark period when he was a Doge. We went through that. He ultimately was a fork in the road. Clock struck midnight. He picked Tesla. And now I believe that path to $2 trillion market cap is on the table because of autonomous and robotics. And I just believe now you'll still have some chop in terms of demand in near term. But I think overall, this is going to be a golden era for Tesla.
Dan, there'd also been this bull case after the Trump election, why you saw Tesla surge so much. And that bull case went something along the lines of easier regulation for Tesla, that he had the ear of President Trump. If we are seeing Elon Musk starting to pull back, not spending as much in D.C., not as present with Doge, does some of that need to be priced out as well then?
Yeah, look, it's a good question. I mean, obviously, Doge took on a life of its own. I think Musk recognized that in terms of some of the brand damage, which is ultimately why he had to leave Trump White House. But in terms, I do believe you are going to have less regulation. I think the pathway to autonomous is going to be there on level 4, not just for Tesla, but for Waymo and others. But I don't think it's priced in. I do not believe the market is fully pricing in the opportunity in terms of autonomous and robotics for Tesla. And I think what we saw from Musk, that's a different Musk. That's a committed Musk. Look, leaders lead. And that's what Musk is doing.
The issue down at play then, if you believe the long-term valuation comes down to autonomous, most people do. They agree with you. You've got to understand whether it's a regulation issue or a tech issue. And if you look at Waymo, Dan, it doesn't look like a regulation issue for the likes of Waymo. Waymo's now doing 250,000 paid rides a week. A few years ago, that number was 10K. Dan, how much of a challenge is coming from Waymo?
Look, I mean, Waymo are $230,000 cars, and they're essentially in 4 cities. I mean, obviously, they'll expand. But I believe Tesla is going to go past Waymo 100 miles an hour in the left lane in the next year. In other words, I believe Tesla, from a market share perspective, given scale and scope and what they could do across the U.S., I think Waymo will be a rounding error relative to what Tesla could do on autonomous. Clearly, Waymo's had the leader. But I don't view that as something that's static. I think Tesla has a huge opportunity ahead of it.
Without a doubt, that can change, Dan. But what are you looking at right now that's giving you that confidence? It's clearly not blind hope, at least it shouldn't be. What gives you that confidence in the moment? What do you see?
I mean, what I see is Austin's going to take off in June. I think you're going to have basically 15 to 20 cities in the next 6 to 9 months. And the scale, I mean, we're talking about a few 100,000 robotaxis into next year, and ultimately something that's going to approach in the millions. And I think when you look again to level 4 and you look at where they're heading, I think that's the new era of growth for Tesla. And that's why it was so important for Musk to sort of, make that 180, refocus on Tesla. And that's what he's done. And I think if I told you a month ago that we'd be talking about this, it would be a dream scenario. I think that's what the stock's reflecting too, from those dark days that we saw, starting in the early parts of the Trump administration from Musk.
Dan, appreciate the update. Dan Ives of Wedbush, still bullish on the name. Is it a reputational issue or an operational one? Because one is much harder to fix than the other, I think, at the moment.
Well, even if it is reputational, which I'm assuming you're saying is less difficult to fix, you have a problem where European sales are really low. You still have President Trump in the White House, who still refers to Elon Musk. How difficult will that be to fix at this moment? Both are not easy, John, I have to say.
Both are super hard to repair. You've got to understand what the problem is, though, before you go about fixing it. And that's the issue at play, I think, for that company at the moment. Up next on the programme, Stuart Kaiser of Citi, Romina Boccia of the Cato Institute, Aasem Khalil of Goldman Sachs, and the former New York Fed President, Bill Dudley. The second hour of Bloomberg Surveillance is up next.
I think the stock market is backward looking at the moment.
We clearly have entered a very volatile period right now.
Corporate and personal balance sheets are in really good shape.
Consumers are really nervous, and so there's a little bit of a pullback.
When consumers start seeing prices going higher, they're not going to be happy. They will pull back.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Equity futures just a touch softer, lighter negative. We're down across the board here, down by 0.7 on the S&P and snapping a 6-day winning streak in yesterday's session. We add to those losses this morning. We add to the losses in the bond market too. Let's focus on this bond market. The long end of the curve. Yields are higher by 6 basis points on a 30-year. We're back through 5%. But it's not just a domestic issue. It's not just the United States. It's global. It's Japan. It's the UK. Gilt yields this morning, Danny, higher at the long end by 8 basis points.
It's interesting because George Saravelos of Deutsche Bank has been making the argument that the JGB sell-off is a bigger issue for treasuries than it is for the Japanese. You could make the same argument for what's happening in the UK because all of a sudden yields are higher. Yields look more attractive to local investors. So Peter Tchir was making this point too. Why would you go through the headache of converting your money into dollars to buy treasuries when all of a sudden you can get something from your local paper?
Priya Misra, JP Morgan Asset Management, joining the program earlier this week, doesn't want to touch the 30-year. The why? Look at what's happening globally. Look at what is happening in Washington, D.C. Does this tap the brakes as they try and advance that bill down in Washington?
Well, also part of the problem is whatever they get done, is it locked in for the next decade? If you have an issue where in the midterms you might have something that looks more like a split Congress, the reconciliation process is very difficult. Is this their one shot to get something done? And if they get something done and it means higher deficits, can you really reverse it? You might not be able to.
We've got a lot to work through this morning. It starts with this bond market, 2-year, 10-year and 30-year. Yields up across the curve, more at the long end. This curve is steeper. The 30-year is up by 6 basis points. Coming up this hour, we'll catch up with Stuart, Kaiser of Citi, with stocks ending a 6-day winning run. Aasem Khalil of Goldman Sachs on the state of the banking sector, and former New York Fed President Bill Dudley on why the Fed should prepare markets for the unexpected. That conversation about 40 minutes away. We begin this hour with our top story. The tax debate on Capitol Hill continues. Joining us now from Washington is Annmarie. Annmarie, we've talked about this timeline. It's aggressive. Can they stick to it?
It's very aggressive, and Speaker Johnson really wants to stick with this timeline. That is why he's at the Rules Committee right now, Jonathan. They've been working throughout the evening into the early hours. The first panel of that hearing wrapped up about 4:30 a.m. So this is going to go into the morning. So Speaker Johnson needs to make sure that this passes through the Rules Committee, and then he can put it on the House floor. And he wants to do all this before Memorial Day. What we are waiting on is the text of these backroom dealings that were done. We do understand, according to reports, that Johnson made a deal with blue state Republicans, a new structure for SALT, lifting the SALT cap from $10,000 to $40,000 for those making less than $500,000. And then also, for those that were worried that this just doesn't do enough, the fiscal hawks, a little bit more conservative, those individuals potentially will get the clawing back of the Inflation Reduction Act tax credits sooner than was original in the bill. But again, we need to wait for this text. And I would argue that at this moment, this is actually the easiest part for Speaker Johnson, because then this bill is going to go to the Senate. And already you had Senate majority leaders talk to Jake Sherman in Punchbowl News this week and saying he thought $40,000 for the SALT cap, that new cap potential. He said that's quite generous. You could see a lot of tweaks happening in the Senate. Then it has to come back to the House, and that is going to be incredibly challenging for Johnson to get the votes after you have the Senate edit their package and their bill. And that's when the closer, the President of the United States, is really going to have to make his pitch to Congress.
Annmarie, how effective will that pitch be when he already tried to do it earlier this week, already tried to implore the SALT caucus, as it were, to move forward, and seems like he didn't make much movement there?
Well, I would say it's early innings. When you have an individual like Representative Lawler pushing back, this individual, it's been teased that maybe he wants to run for governor. There is something he wants. So he cannot capitulate so early on. This is the first, second inning of a very long ball game, even though an individual like Terry Haines of Pangaea Policy is saying that he thinks 80% chance this gets done by July 4th. But you have to remember, this is all a negotiation. So every faction, every individual is going to come in with their maximalist approach. And they need to go back to their constituents, think of the midterms, and say, did you see how hard I fought? I even went up against the President of the United States to try to get a higher SALT cap. And I would say that the president yesterday kind of understood this, and he said that this was a bit of a pep talk. He's going to have to make another number of visits to Capitol Hill and potentially even have some of these individuals come into the Oval Office.
Annmarie, thank you. And this is just to address the issues in the House before we get to the Senate. That's the view from Washington, D.C. Here's the view on Wall Street. Stuart, Kaiser of Citi writing the following. Corporate America and the FOMC are in wait-and-see mode at a time when the signal-noise ratio of economic data is poor. Stuart joins us now for more. Stuart, good morning.
Hi, good morning.
Memorial Day, very, very close, not even a week away. What are the biggest risks to the summer vacation? over the next few months?
Look, I think the one that got activated over the weekend was long end bond term premium kind of blowing out a little bit. I think a lot of investors had that on their radar, excuse me, but thought it was going to kind of be more of a midsummer type issue. The Moody's downgrade and now that kind of failed committee vote late last week, I think kind of brought that to the forefront. To your point, price action is also kind of demanding people focus on it. So I think the number one risk right here and now is that long-term bond term premium. As you get into the summer, I think, as we mentioned there, corporate America sort of punted last quarter. I don't think during July earnings, the street's going to allow them to punt again. So I think as you get into the summer, these potential downside risks to both EPS and GDP become a real issue. But for now, it's all about these negotiations on the bond term premium.
Let's deal with one at a time. Let's start with bonds and the negotiations down in Washington. It's not just the US. Japan, messy auctions, the UK, hot inflation. Yields are up around the world. What do you think is behind some of that, and what does it mean for stocks?
Look, I think our view coming into the year is that long end of the bond curve is going to be impacted both by the deficit and budget and tax negotiations as well as tariff policy. I mean, I think there was a view that tariff policy disrupts kind of long-term, steady state trade policy. And to the extent that gets disrupted, you can get people a little uncomfortable owning that longer-term U.S. credit. So I think it's a combination of both. We have, a 20-year bond auction later today, which is clearly going to get a lot more attention than it normally would. So, yeah, I think it's a combination of the deficit. Look, deficit to GDP is like 6.5%. Back in 2011, when the S&P downgraded the U.S., it was 8.5%. The difference there is valuation was half what it is now, and you were also coming out of the financial crisis. So that deficit was high for a reason. The issue now, which a lot of economists have highlighted, is the fact you have a very large deficit on the back of a few years of really strong economic growth. So that's really concerning people, I think.
Well, yeah. Price to equity multiples price to earnings multiples are something above 20 times right now. It is pretty remarkable. And you point out, we still face trade headwinds. Even if things stay as is, that is a significant increase in what tariffs look like. Are we underpricing the real economic damage, the real damage to corporations that might come from having to pay higher prices?
I think investors are really concerned about that, just because even if you're at 10% across the board and call it 25% on China as a broad number, that is still a significant increase, and it still has potential downside risks to earnings in particular. As I mentioned, I think people were comfortable allowing companies to punt for a quarter to get a little more information because investors themselves didn't have enough information to kind of argue with them, I guess you would say. As you get into July, I think that's really going to come to a head. And we're going to have to see what happens. To be fair, though, there's a group of investors that believe we're going to a recession, right? And, an economist probably tell you that number is between 30 and 50%, give or take. There's also, though, a group of investors that say, look, that risk is well understood and fully priced. Are we underpricing the idea that this economy, may be more resilient than expected? So you've kind of ended up with these two camps out there, and those folks are the ones that are creating the volatility in the market.
Well, one of the other arguments that had started out this year as to why perhaps U.S. equities wouldn't do as well is because the money was flowing into other markets. But even though U.S. equities have started to rally, the DAX still closed at another all-time high. The Stock 600, that's closing in on its records, too. What do you make of stocks in Europe still exhibiting so much strength at the moment?
I think part of that is, frankly, the fiscal. A lot of people did not expect Europe to do fiscal and defense spend, and they were able to kind of push that through in Germany. And I think that was a little bit of a game changer for longer-term investors and real money. So I think you're seeing that go in there. And some of it, to your point, is just a little bit of discomfort with the U.S. and the uncertainty here. So you sort of have an uncertainty bit taking money out of the U.S., you have, potential game changer on fiscal in Europe kind of, pushing them higher. And that combination has been really powerful. We're going to have to see. You haven't had an extended period of Europe outperforming the U.S. for, almost 20 years at this point. So it's going to be really interesting to see 3 months from now what that conversation looks like.
Morgan Stanley capping it at half a year. Mid-year outlook. They say this morning. U.S. over rest of the world. U.S. stocks to benefit from earnings revisions troughing in the near term and dollar weakness. How important is the dollar weakness going forward?
I think it's why you get in that dollar weakness. When you get gold moving as aggressively higher as it has been, I think that's viewed as sort of I want to be short the dollar, but I'm not sure what other currencies I want to be long. So, to the extent that you keep getting gold higher, then I think the dollar weakness is arguably a risk factor as opposed to just sort of being driven by fundamentals. So I do think the why will matter there. In terms of earning revisions, we'll have to see. I mean, U.S. numbers have not come down that much quite yet. And if the 2/3 of companies that didn't guide down ultimately get forced to by tariff policy, then you might not get as much of an earnings uplift as you're hoping for. But again, it's investors we talk to, I think, generally have said we're less overweight the U.S. than we have been a while, and it makes us deeply uncomfortable.
We got a cut to guidance this morning. Target, sales weaker than expected, cut to the outlook. Stock is down in the pre-market by 4.5%. What's your read on retail? What's your read on the U.S. consumer?
Yeah, I mean, retail is an interesting one. If you go, you have Target and Walmart have kind of been, two of the big bellwethers there. I think, Walmart's message was in a post-tariff environment, our pricing advantage is at least as wide. And maybe what you're seeing from Target's numbers is a little bit of a confirmation of that. I do think investors are sniffing around for what in the retail space can I own? and Scott Cronin on our equity research team has kind of done that work. And there are stocks there. The question is, how much bravery do you have to kind of step into those stocks ahead of what could be, a difficult summer from a spending perspective? The tough part here is if the unemployment rate ticks higher in early June, is that signal or noise? And again, I don't know how the market's going to deal with that. I would assume, and Bill Dudley on later may have a lot more insight into this than I would, but I mean, it seems like for the time being, the Fed is going to get a little bit of a pass on this data, at least for a couple of months. So it makes it even harder to read the consumer because the incoming data, again, could be signal, could be noise, and it's hard to determine.
Danny, this is so important because if we do get that weaker data, there are some people who think it's dated because we've just had the truce between the US and China and they believe the policy front improves from here.
I think a lot of people will look at the data and say it is extremely distorted at this moment, much like we have for most of this year. If you get this pull forward of not just companies trying to ship things in, but also consumers deciding that they need to get out now before an increase, how much can you really trust it? Are we really going to continue to trade off of it? How much is the Fed going to trust it? They've told us as much that they're waiting maybe until months, maybe until September to really start reading into it.
Bill Dudley, the former New York Fed president, 30 minutes away. Stu's going to stick with us. Stuart Kaiser of Citi. Equities at the moment recovering. We're down by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg brief with Yahara Anand. Hey, Yahara.
Hi, John. The U.S.-China tariff truce triggered a sharp rebound in trade activity. Container bookings to the U.S. more than doubled in the week beginning May 12th, and shipping rates from Shanghai to L.A. jumped by the most this year. Prices for space on ships across the Pacific into the U.S. also rose, with spot rates from Shanghai to Los Angeles jumping about 16%. Meanwhile, CVS is rolling out new ideas to boost vaccinations. Sources telling us here at Bloomberg the company is incentivizing staff with bonuses and raffles, plus it's phoning and texting customers to encourage vaccinations. The move comes as the FDA says it will no longer approve COVID booster shots for healthy adults and kids. And Elon Musk plans to cut his political spending after spending approximately $300 million to back Donald Trump's presidential campaign. Speaking to Bloomberg at the Qatar Economic Forum, Musk did not rule out future political contributions, saying, if I see a reason to do political spending in the future, I will do it. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Just staying on the Qatar Economic Forum in Doha, Bloomberg in conversation with CEOs about navigating volatile markets. Bloomberg subscribers can tune into the interview on LiveGo on the Bloomberg terminal. Up next on the program, Trump looking to strike a deal.
So this is the biggest tax cut in the history of our country. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse.
Up next on the program, an agreement, potentially, between Speaker Johnson and the holdouts, coming to an agreement for a $40,000 SALT deduction cap. We'll get you the latest reporting down in Washington, D.C. in just a moment. Live from New York City this morning. Good morning to you all. Equity futures on the S&P recovering somewhat. We're down by 0.6% in the bond market. This is the one to watch. Yields on a 30-year higher by 6 basis points. The 30-year this morning 5.03%. Under surveillance this morning. Trump looking to strike a deal.
So this is the biggest tax cut in the history of our country, or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse. I'm a cheerleader for this party, and I'm a cheerleader for the country. Much more importantly, for the country.
That was the push from the president yesterday. Here's the deal this morning. House Speaker Mike Johnson saying the House has come to a $40,000 SALT deduction cap agreement. Annmarie joins us now from Washington, D.C. with the latest reporting. Hey, Annmarie.
Hey, Jonathan, that's right. The Speaker Johnson this morning basically saying what we've been talking about all morning in reports, that they have come to this agreement with the SALT faction to raise the SALT deduction from $10,000 to $40,000. And to discuss all of this is Romina Boccia, Director of Budget and Entitlement Policy at the Cato Institute. Now, Romina, this just came through that the Speaker has talked about, that this is what they've agreed upon. We haven't seen the text. But I know you recently tweeted that the idea of expansion of SALT gives you high blood pressure. How would you expect, then, the Speaker to get some of these blue state Republicans on board?
Well, the blue state Republicans are already on board. The problem we have with this bill is, as President Trump said in your clip, they are not making any meaningful spending reductions. We're looking at a $5 trillion debt increase over the next 10 years, which would add fuel to the fire because we already have a built-in more than $20 trillion debt increase under the current Congressional Budget Office baseline. So this accelerates the debt by an additional 25%. And the current negotiations, even after Moody's downgraded the United States debt just last Friday, are moving in the wrong direction. There's the potential for an even bigger debt increase now that Republicans are talking about expanding the state and local tax deduction so significantly, which, by the way, is just a handout to campaign contributors. So it's a symbol of what's broken with this process. Instead of pro-growth policies, we are seeing these tax giveaways that primarily serve the purpose of currying favor with favored constituencies.
Right, but I think a blue state Republican would say that those states contribute to the most of the federal government. I believe New York gives like some $90 billion to the federal government, more than they take in. And if this bill does not get passed, though, the cap goes back to pre-2017 TCJA, and there is no cap. So how do you think they should work around this, and what kind of agreement would you suggest?
First of all, it's not the states that give money to the federal government. It's American workers who are earning that money. And there's no reason why taxpayers in other states like Texas and Alabama, for example, should be picking up a larger federal tax tab in order for states like California and New York to be able to be fiscally irresponsible. That's the whole debate over this SALT deduction, is who should bear the burden of federal taxes. Of course, ideally, we would reduce the size of the federal government, reducing spending, which is excessive at $7 trillion, with deficits in the 6 to 7% of GDP range and rising. We're already paying $1 trillion on in interest costs on the U.S. national debt. And if this bill passes and bond markets continue the way that they have, with rates staying much higher than the CBO initially projected in the 4.5 to 5% range, we could be paying more than $2 trillion in interest alone by the end of this decade if this bill passes. So federal taxpayers cannot afford to subsidize blue state Democrats or Republicans.
They're clearly not going to be addressing the deficit in this bill. And to your point, interest on debt is currently the fastest growing part of the U.S. budget. So after this bill likely passes, what's your advice to them to try to get our fiscal house in order?
Well, right now they shouldn't be passing such a bad bill because we've already heard from markets, we've heard from Moody's, which has downgraded us because of this fiscal unsustainability that we all know is going on in the federal government. And our political system is showing absolutely no signs of slowing down the borrowing. And this is going to continue to rattle bond market holders. And we could have a U.S. trust moment where politicians should be making an about out phase and actually making meaningful spending reductions and pulling back on some of those tax giveaways, including no taxes on tips or the SALT deduction. But if they decide to proceed with this bill, I say put in place an independent fiscal commission, perhaps modeled after the base realignment and closure commission. You might call it a budget realignment and control commission. But I think politicians have demonstrated that they're not willing to make the tough choices that are economically necessary if they're politically unpopular to correct the U.S. fiscal course and stabilize the growth in the debt. Something has to give before we have a severe fiscal crisis in this country, and delegating that task to an independent fiscal commission might just be the pathway to get those important entitlement reforms and close some of the tax loopholes that are riddling our tax code and making it less efficient and unnecessarily costly.
Romina, thank you so much for your time this morning. Jonathan, that was Romina Boccia of the Cato Institute, basically saying Congress should start listening to the bond market.
Let's get that headline just crossing just moments ago, about 10 minutes ago, actually. The Speaker Johnson says there is an agreement on a $40,000 SALT deduction, and that agreement has been reached. Now, Stu, who's still with us, Stuart Kaiser of Citi, this should ease the passage of this bill, at least in the House. Then you've got to get through the herding of the cats in the Senate. But we're moving forward in the right direction. Good for stocks, maybe bad for bonds, which might be bad for stocks. Is it good or bad for markets?
I mean, I think it's net positive for markets just because you need those tax cuts, the tax deal to get extended. And, any friction that would kind of work against that, I think that would be a bigger headwind than anything else. But yeah, to your point, if you get a dislocation in the long end of the yield curve, it's going to be an issue. But, I think the market will generally be happy that a deal is getting, passed in the House. But, to Annmarie's point before, you still got to go to the Senate and then you got to reconcile again. So got a feeling we're going to be talking about this for a while.
Well, Stuart, quickly, what is it when it becomes an issue? We're already at 5% on the 30-year yield. If not that, then what for stocks?
Look, not our in-house forecast, but people have thrown six handles out there in terms of where the 30-year can get. Look, again, if you got a real acceleration higher, like a highly volatile move higher, then I think that becomes an issue for equity risk premium without a doubt. The challenge with all of this, Romina's point before, is also that if you get a recession at these levels of deficit, it gets really ugly really fast. So, they're kind of playing with fire a little bit because a lot of the logic of why they can do this is, well, we're cutting costs, we're deregulating, we're going to grow our way out of it. Well, that's fine, but you're like threading multiple needles to have that work. And if it doesn't work, then the deficit all of a sudden becomes an issue super quick.
Bond yields up this morning by 4 to 5 basis points across the long end of the curve. Stuart Kaiser of Citi. Stuart, it's good to see you, sir. That's the situation in the bond market at the moment. Let's get you the situation in Dallas, Texas. Lisa's on tour. She's standing by with more. Hey, Lisa.
Hey, John. Yeah, you know how the Fed does Fed Listens, and it goes around and tries to understand how companies are doing. Well, we're doing a surveillance listens tour, and this comes at a time where you're talking about high tax states. We're going to the low tax state that's attracted so many different corporate headquarters over the past 5 years, and really talk to one of the drivers of this in the investment banking space, that is Goldman Sachs' Aasem Khalil, who has been leading the charge in terms of expanding the Dallas office here for Goldman Sachs to be the second biggest in the country. It just goes to show there have been real consequences since the pandemic, and there are real reasons why some of these high tax states want to make sure those deductions go in place, because they have lost a lot of business since then. And it has come to places like this in Dallas, where we'll be going to different corporate headquarters and discussing things with them and finding out what they think about the world.
You check out some real estate for us as well. Bramo, looking forward to the conversation in just a moment. At least we'll have more for you on the other side of this commercial break. Equity futures on the S&P 500 recovering here, still negative by 0.6%. A potential agreement down in Washington happened to drive bond yields higher across the curve, higher by 5 basis points at the long end. Your 30-year back through 5%. Live from New York, this is Bloomberg. We have a SALT deduction cap deal down in Washington, D.C., according to Speaker Johnson. Equities recovering just a touch. We're negative by 0.5% on the S&P 500. On the NASDAQ, we're down by 0.5. With some of the movers before the opening bell, your morning movers, here's Yahira. Hey, Yahira.
Hi, John. We start with Target, the latest retailer to report, continuing to fall this morning, down 4% now. The retailer slashed its sales forecast after a weak quarter. They're saying shoppers are visiting their stores less and not spending as much. And we're hearing some pretty strong words from CEO Brian Cornell saying, I want to be clear, we are not satisfied with these results. And because of that, there is already a big executive shakeup underway. Moving in the opposite direction, we have home improvement retailer Lowe's. Those shares are up 2% now. They posted solid results and reaffirmed their total sales forecast for the full year. So what these earnings are telling us, along with Home Depot yesterday, is that people are apparently investing in their homes. Maybe at a time when rates are high, if you can't get a new home, you're investing in the one you already have. And last up, we end with Palo Alto Networks. Those shares are down 3.7% despite the cybersecurity company posting better than expected revenue and earnings, but growth in a key metric that measures future revenue expected from current contracts slowed by the most in 6 quarters. It was still up 18%, but not enough to satisfy Wall Street's lofty expectations. John?
Yahara, thank you. Appreciate it. More from Yahara in about 10 minutes' time. Let's turn to our top stories on our radar this morning. House Speaker Mike Johnson telling CNN that Republicans have reached an agreement on a $40,000 SALT deduction. The deal looking to keep President Trump's big, beautiful bill on track in the House before moving on to the Senate.
And it's one that the market seems to be taking in stride, a little bit less of losses this morning. The issue, though, is what will inject any sort of fiscal discipline into this conversation. You're not having that at this moment. It gets said time and time again, oh, you need a Liz Truss kind of moment. I don't think that's fair, because in the UK, you can have a Liz Truss moment, and their political system is such that you can quickly pivot and you can quickly make changes. We don't have that same system here. If this bill does get passed and then you have something of a Liz Truss moment, how does that get undone? It's not as easy, so I don't know if the same market mechanism can really kick in this time around.
Yeah, and as you know, Danny, you lived it. The market situation in the UK through that time was a unique situation. It involved pension funds. That's not what we're seeing play out in the bond market here. When people use that phrase, I think what they're referring to ultimately is what you're talking about. Will it drive corrective change? Does it force a change in leadership and a change in policy? And quite obviously, that's not going to happen in Washington.
Well, if the current market action is any guide, what you get is just this slow bleed higher in yields. You get 30-year yields that bump around 5%, but you don't have any sort of mechanism that has this big rupture. Sure, you saw in April, but it quickly corrected. So if it is just this slow move higher, how is something that's going to wake up Congress? It's just sort of this slowly worsening of things, slowly paying more. It's not enough to shake anyone awake.
It's not this, that's for sure. A 30-year at 5%, and they're still pushing forward. And we've struggled to close at these levels. We should be very clear about that. When you talk about the worries of a buyer strike evolving, sure, there could be one down the road. Then we saw evidence of that in Japan. Haven't really seen evidence of that in the US, at least not over the last several weeks.
Right, and every time there's an auction, we say, oh no, look at the auction, it's going to be horrible. And it actually ends up being okay. Maybe the change will happen if you continue to see JGBs hit record highs, UK gilts also moving higher with yields. Maybe that's the mechanism that moves people abroad. Not necessarily what's happening here, but saying, finally, I can get some yield at home.
This push higher is global. It is the gilt market in the UK, seeing it in Japan again this morning. Later on this afternoon, this is just for Lisa, 1 p.m., $16 billion of 20-year bonds. The 20-year maturity is a bit of a messy maturity, not a ton of liquidity. So if one was going to go wrong, it might be the 20-year bond later on this afternoon, but I'm not sure what that would mean for the broader bond market.
We can look through it, right? We'd be like, it's the 20-year. No one likes it.
I'm sure that's
Ignore.
What fixed income investors will tell us if this does go wrong. That's the latest on fixed income. Let's turn to tech. NVIDIA CEO Jensen Huang calling on the White House to lower barriers to AI chip sales. Huang also blasting what he calls the failure of US chip restrictions meant to limit China's tech capabilities.
The number he shared was quite jarring. 4 years ago, NVIDIA had 95% market share in China. Today, it's 50%. I wonder if you could look at this and almost use EVs as a corollary. I know it's not exactly one-to-one, but you get in this situation where China uses a bit of our technology, but then is essentially forced to create their own homegrown heroes that quickly surpass what's happening in the US. It hasn't happened yet, but with the advent of DeepSeek, with Huawei gaining in terms of what they can do technology-wise, it is a real fear, and I think Jensen Huang is accurately capturing that.
NVIDIA in line with the market today, just a bit softer. We're down by 0.9%. Just wanted to finish on the Federal Reserve and the latest from FOMC officials stressing this wait-and-see approach. We heard from the San Francisco Fed President Mary Daly saying the central bank should stay in a, quote, central position. We heard from John Williams earlier this week making the case that he might not know what to do until September.
We also heard from Beth Hammack, and this one confused me, considering a lot what we've been talking about this morning, John, that they have a lot of information to learn in the coming months. I would like to know what that information is. You look at the soft data that we've been getting in recent months, it's highly skewed by politics. The hard data we've gotten has been highly skewed by everyone trying to front load where we go in the next 90 days. So they have to sit on their hands in part because you kind of can't trust the numbers in front of you. What do you do? How do you make policy when you can't even tell what's a sustainable trend, what's getting pulled forward? And again, what is politics?
They're dependent on other people's policies, the politics in Washington. It might be September before you get your hands around what policy looks like. It might be months after that to know what's going on in the economy.
Well, to that point, Michael Gapin over at Morgan Stanley doesn't think that we're going to get any cuts this year. He thinks it'll be next year because the data will hold up. You'll still have no recession because tariffs have come in a little bit, maybe a touch of inflation that scares the Fed, but that acts as transitory. It comes in and then you get weakness. This is a market that is pricing in cuts in October. Do we need to reprice things and assume it doesn't happen until 2026?
That's the latest on the Federal Reserve. We'll have more with Bill Dudley a little bit later. As promised, let's head back to Dallas, Texas and catch up with Lisa, standing by with a special guest. Hey, Lisa.
Hey, John. Yeah, one thing that companies don't have is a luxury to wait and see, like so many Federal Reserve officials are saying that they have to do. I am here with someone who is pioneering the shift of investment banking into Dallas, Texas. It is Aasem Khalil, who is the head of investment banking client services at Goldman Sachs. And Goldman Sachs has been rapidly expanding in Dallas. It's going to have the second biggest office here behind New York at a time when you've seen just a flood of corporations move their headquarters to Texas. It has been one of the biggest absorbers of new corporate headquarters since the pandemic. Why Texas? Why Dallas in particular, Aasem?
Well, Lisa, thanks for having me. It's great to be here. I'd say a couple of things. I moved down here almost 9 years ago at the firm's request. It was a little bit of a surprise as a lifelong New Yorker.
Happy surprise?
It was a very happy surprise moving to Dallas in retrospect. So we relocated here because the firm had a view, rightly, that Dallas is an emerging city and that there is an up-and-coming business population here, that there was tons of market cap already located in the city, and that more and more companies were going to relocate to this region for a handful of reasons. One is the centricity of Dallas. It's in the middle of the country, so access to either coast is within 2.5 hours. Number two, the university pipeline here is incredible. You have SMU, TCU, Rice, A&M, UT, etc. There's just a never-ending flow of new talent that's coming to the state through the context of universities and who are looking for jobs in Dallas.
At this point, everyone's been talking about taxes and how there's certain states that are high tax states, there's certain states that are low tax states, there's certain that are just lower cost in general. New York City, as we all know from having raised children there, can be particularly expensive. I'm just wondering how much that's really one of the biggest drivers for a lot of these corporations.
I think it's a factor. I'm not sure it's necessarily the biggest driver of why people are relocating. Keep in mind, DFW Airport is one of the most incredible tools that Dallas has, meaning that if you run a global business like a lot of the corporations that are based here do, you can access your customers all over the world with a direct flight on American Airlines or one of the other airlines in the city. It's pretty remarkable when you think about how accessible the world is from Dallas. There's plenty of space. The schools are good. The quality of life is very high. So there are lots of things to love about being here in Dallas as opposed to just the taxes. But there's no question it's a factor. I don't think it's the driving factor.
I love that you're speaking to yourself from 9 years ago. Awesome. It's really got all of these advantages. Trust me. I am curious about Wall Street South. A lot of people are Southwest. People have been talking about that. There's a new exchange that's going to be coming out. We've seen a 27% increase in investment banking and services staff in this city since the pandemic. How much is this really going to be kind of the Wall Street Southwest? How much do you really feel that gravitational force?
Well, I think there's enormous momentum. So I can speak for Goldman Sachs. We're building a campus right here in the heart of the city, which is really important for us to be in Dallas proper. So a lot of the corporations that have moved here have moved to some of the outlying cities around Dallas. So Plano, Frisco, McKinney, these are about 20, 30 minutes outside of Dallas. It was really important for Goldman Sachs as an urban firm to have our presence in the heart of the city. So we're building our campus here. We have 4,500 people in the city already. When I got here, we had less than 900 9 years ago. So the growth has been incredible, and that's only going to continue to happen. A lot of our competitors have also established a presence in the city. So you have people in Plano. There are folks that are in and around kind of Wall Street South, as you referenced. But I don't see any slowdown. It's too good of a place to live and to work and to be, quite frankly, to not have that kind of growth.
One thing I'm struck by is that when I talk to corporations in different cities, it seems like they have a very different view on where the economy is at, on kind of how ambitious to be with expansion plans. And as we were saying, they don't have the luxury of wait and see like the Federal Reserve does. What are you hearing in terms of just how much people are putting on hold their mergers or acquisitions, their capital investment plans?
So I'll give you a Texas perspective, and then I'll give you more of a national and global one. The Texas perspective is still one of optimism, generally speaking. This is a state that's had incredible economic growth and will continue to be one of the handful of states that grow in the country. So that's great for Texas. When we talk to CEOs and corporations in and around the state and in and around the country, people are cautiously optimistic, right? People want to grow. They want to continue to drive their businesses to create value over the long term. But of course, there's some caution given the geopolitical environment, given the backdrop. But generally speaking, companies are still making decisions that are going to allow them to grow over the course of the next several years. So if you look at the M&A environment, it's, well, again, I'd phrase it as cautiously optimistic. Deals are still happening. Transactions are still being announced. Some actually large transactions have been announced in the last couple of weeks. But if you look at the middle market, that call it $2 to $5 billion range, there has been a tremendous amount of activity, double-digit growth year over year.
Which really highlights how there's sort of a disparity between some of what we're hearing out of the likes of, say, Target this morning came out and talked about how consumers are really pulling back and they're getting much more cautious. And then you see other companies that are still expanding that can't wait and see and are optimistic. Is there a sense that the U.S. economy is just driving that forward? And I ask you this not just as the head of investment banking client services at Goldman Sachs, but also as someone who sits on the corporate advisory board at the Dallas Fed and is very involved in all of these kinds of conversations.
Yeah, so again, I think that there is a view that the U.S. is still the best place to be, right? And that the winds of change are going to continue to shift back and forth. But still, if you think about our economy, you think about what the U.S. has to offer, so to speak, particularly relative to the rest of the world, this is still where companies want to be and where companies want to operate. There's no question there's concern about the state of the consumer. There's no question there's concern about the forward for the economy. The Treasury auction, as we were talking about earlier, that comes into focus.
Thank you, John, by the way.
So there's a lot of things that are out there. But again, this cautious optimism that we will work our way through. The fundamentals, of course, are quite sound. We'll work our way through some of the noise that's in the markets today. And that over the long term, if you're running a business and you've got a view that this is the right thing for your company, you're going to go ahead and execute on that strategy if it's available. By the way, the financing markets are wide open. So companies are not having as difficult a time accessing capital to continue to grow.
Just want to finish up. A lot of people have said that Miami is the new Wall Street South, Dallas is the new Wall Street Southwest, that New York's getting a lot of competition. Do you think that the Dallas office could ever be bigger than New York's office for Goldman Sachs, or that this presence could really rival it in a more material way?
Well, I would never say never, but I will say certainly that our headquarters are in New York. Goldman Sachs will always be a New York-based firm, but could Dallas continue to grow in size? Of course we're going to continue to grow, right? That momentum is there, and that's not going to change. Could we one day be bigger than New York? It's certainly possible. We actually have our presence in India is larger than it is in New York, just given, again, the size and scope of the firm. But we're quite proud of what we've been able to build in Dallas, and we think the forward's very bright. So we'd expect more growth here. But don't mistake it. We are a New York-based firm, and Dallas is going to continue to be a very important part of the Goldman Sachs ecosystem.
Spoken like someone from New York City heading to Dallas who has settled here with his family. Aasem Khalil, thank you so much for being with us. Really wonderful to speak with you. That was Aasem Khalil of Goldman Sachs, head of their investment banking, client services, and the office here in Dallas, Texas. John, I just want to thank you again for talking about that 20-year auction. I do think it's going to be very important and potentially the risk event of the day.
At 1 p.m. Eastern Time. Must-watch TV. Thank you, Bramo, as always. 10 years ago, when you were said, as a lifelong New Yorker, you've got to move, you're like, no. Then you speak to the accountant, and you're like, oh, OK, maybe. Tax bill.
Yeah, certainly. And then if you get a salary that looks similar to New York City salary down in Texas with those, hey, not a bad life. You get some sun, you get some warm weather. Hard to argue with any of that.
It's why a lot of people have moved over the last few years, that's for sure. And other things too. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Oil prices are rising following a CNN report that Israel is preparing a potential strike on Iranian nuclear facilities. It wasn't clear that Israeli leaders have made a final decision on whether to carry out the strikes, CNN said, citing unidentified officials. Oil has been volatile since last week on mixed headlines about the fate of Iran-U.S. nuclear talks. Meanwhile, the FAA will continue limiting flights at Newark Airport after recent tech outages and staffing shortages. Regulators saying they'll permit a maximum of 28 arrivals per hour through June 15th. After that, 34 planes will be allowed per hour through October. That compares to more than 70 hourly flights the airport had been handling in peak periods. And former New York Governor Andrew Cuomo is reportedly under criminal investigation by the Justice Department. The New York Times reported the DOJ opened the investigation after Republicans accused him of lying to Congress about decisions he made during the coronavirus pandemic. Cuomo is currently a front runner in the New York City mayoral race. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, wait and see.
I don't think the Fed fully knows what it's going to do.
They will have to keep rates higher for longer in response to almost no matter what growth is doing.
I don't think he ruled out a cut in June, or I don't think he ruled out really anything. He created max optionality for himself.
The Federal Reserve in wait-and-see mode. We'll catch up with the former New York Fed President Bill Dudley up next. Equities lower this morning. We're down by 0.5% on the S&P. Likewise on the Nasdaq. In the bond market, yields are higher by 5 basis points. The 30-year of 5.02%. As Speaker Johnson signals an agreement on the SALT cap deduction down on Capitol Hill, just paving the way to advance this tax bill. Under surveillance this morning. Wait and see.
I don't think the Fed fully knows what it's going to do.
They will have to keep rates higher for longer in response to almost no matter what growth is doing.
We can cut rates, but in line with slower growth and lower inflation.
If economic momentum is slowing down, interest rates will come down as a result.
I don't think he ruled out a cut in June, or I don't think he ruled out really anything. He created max optionality for himself.
So here's the latest this morning. Policy uncertainty leaving Fed officials in wait-and-see mode. The former New York Fed President Bill Dudley with this to say. The Fed should prepare markets for the unexpected. To an unusual extent, the world's most powerful central bank leaves the public in the dark. It can and should do better. Bill joins us now for more. Bill, let's take it to the top, from the top, and welcome to the programme, sir. What is the importance of a central bank articulating, conveying its reaction function, and where do you think the SEP falls short at the moment?
The advantage of conveying your reaction function is the markets can anticipate in real time as the economic outlook changes what the Fed's going to do in the future. And that actually speeds up the transmission of monetary policy to the real economy. If the markets know how the Fed is going to adjust, market prices adjust immediately. And so that makes the Fed's response communicated to the market, to the economy more quickly. So that's a really good thing. Right now, the summary of economic projections is very much focused on the modal forecast of the 19 FOMC participants. And so it doesn't really tell you much at all about what the Fed would do if the tariff impact turns out to be larger on inflation or turns out to be larger on growth. How will the Fed pivot? How much will they cut rates? This is why a lot of central banks around the world publish staff forecasts with scenarios or publish committee forecasts with scenarios, which basically the scenarios give you some sense of what the central bank will do if things turn out differently than expected. Last week, Bernanke gave a presentation at the Federal Reserve, the second annual Thomas Lawback Research Conference. He basically outlined why the Fed needs to do this. The Fed is basically an outlier. Every other central bank does this in one form or another that are peers of the Fed. And this would actually help the Fed both communicate and also pivot when things turn out to be different than they expected. If you had a scenario in, say, 2021-22 that inflation might stay higher for longer, that probably made it easier for the Fed to terminate its large-scale asset purchase program earlier.
Bill, isn't this something that effective communication in the news conference could address?
Well, I think the problem with the news conference is the questions are very much focused on the central forecast and the summary of economic projections and the dot plot. So we don't get into a lot of detailed analysis of what if. When Powell is asked questions about, well, what would you do if this happens? He usually says it's data dependent. We'll see. If you have actually sketched out alternative scenarios, that gives you a little bit more meat on the bone to sort of see how the Federal Reserve would react if things turn out differently than expected. The Federal Reserve already does this as part of the staff forecasts that are given to the Federal Open Market Committee participants. They do what are called alt-sims, which basically are simulations of if the world turns out to be different. So this is not like it's not being done internally already at the Fed. I think sharing a little bit more of this information with the public would be very helpful.
Well, Bill, there is one argument that part of the reason market participants concentrate so much on that median outlook is because it is anonymous, that what we get in the SEP, we don't know what each individual member thinks. So it forces us to coalesce around that median. Should there and could there be a scenario where we do know what each individual member thinks, that it is no longer an anonymous survey put out to the public?
Well, another shortcoming of the summary of economic projections is you can't connect the interest rate dot back to the forecast that person made for unemployment, inflation, and growth. So you can't really discern an individual person's reaction function. There have been proposals been made from time to time that let's actually publish what each person's forecast is, so you can actually sort of see that reaction function. I think that would be an improvement over what we have today. But of course, then people are going to be, trying to figure out, well, which dot is the chairman's dot? And I think, communicating broadly to financial markets, to people who are less, Fed watchers than me or you, I'm not sure that connecting the dots really allows you to provide that nuance. But what will the Fed do if things turn out differently than expected?
It does seem like we're in an environment, though, where Chair Powell has been trying his hardest not to make news. And part of that, Bill, seems akin to what's happening in politics, that President Trump is more likely to say something about where the path they're going and his displeasure for it. What changes if we do get something to what you're proposing, where you get more scenarios? Is there increased political pressure? Is that a risk that the Fed should think about?
Well, I think the political pressure of scenarios is that you're writing down things that might be not so good. So let's imagine that the Fed wrote down a scenario where the tariffs are going to turn out to be higher for longer. That's going to feed more into inflation. I'm sure President Trump wouldn't like that, but still, it's a possibility in terms of the economic outlook. And the Fed really does need to think about things beyond the central forecast.
Can we just wrap it up with something you've touched on a few times, Bill? If the dual mandate is in conflict at the end of the year, which side of the mandate do you think they should prioritize?
I think it's really difficult to say at this point because it depends on what the risks are of making a mistake. So let's imagine that you decided, I'm really more worried about the growth side. And then as a consequence of that, inflation expectations became unanchored. Then you'd have a real mess in your hand. You'd be back in the 1970s, not a great place to be. So I think it's really not just about which factor is more off target, but also what are the risks of being wrong. And I think why the Fed is paused right now is because they don't want to be wrong. This is a very tricky situation where you don't know where the trade policy is going to land. You don't know the impact of trade policy on growth and inflation. And you don't know how this is going to affect households and businesses in terms of their attitude toward future inflation.
Bill, appreciate your input as always, sir. Bill Dudley there, the former New York Fed president, with a new column on Bloomberg Opinion. It's also, just to build on that, why Chairman Powell has chosen to prioritise speech after speech, address after address, talking about anchoring inflation expectations, because if he doesn't, that could contribute to inflation expectations.
Well, there's also been a lot of calls recently saying they shouldn't anchor around 2%. We're in this new world of heightened inflation. Therefore, 2% doesn't make sense anymore. Even if it does, John, it gets to the exact problem you're talking about. If you anchor expectations for inflation higher, if you don't go around 2%, does that feed into what they're already seeing? This is a Fed that's also been looking at UMich survey after UMich survey, also showing heightened expectations.
Bond yields bleeding higher this morning, up by 5 basis points, 5.02% on a 30 years. We get some signals from Speaker Johnson that the path is clear to advance this tax bill. We'll talk more about that up next. In the third hour of Bloomberg Surveillance, we'll catch up with Saira Malik of Nuveen, Lindsey Piegza of Stifel, and John Bilton of JP Morgan Asset Management.
The fiscal situation is a real mess. The spending is out of control.
Direction of travel when it comes to the fiscal discussion is only one way, namely that we will see debt levels go up.
I think the bond vigilantes are awake.
The bond vigilantes have to get the attention of the politicians.
The turbulence may go on for years and years, by the way, but we first have to see how the fiscal drama plays out in Washington.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is Bloomberg Surveillance, and the third hour begins right now. Live from New York City this morning. A good morning, a flavour of the price action 90 minutes away from the opening bell. The price action looks like this. Equity futures on the S&P 500 negative by 0.5%, adding to yesterday's mild losses following a 6-day winning streak on the S&P. The attention shifting from tariffs to taxes, and that means our attention shifts back to the bond market. At the long end of the curve, the 30-year yield is higher by 5 basis points. We're back through 5%. 5.02%, ahead of an auction a little bit later on this afternoon. 20-year bonds coming to market at 1 p.m.
I also think it's going to be really interesting to see if we can close at these levels, because we've really struggled to do that. No one wants to be a seller at 5%. But, John, one of the troubling things of this isn't just that treasuries are selling off. It's that the dollar is selling off alongside of it. And in some cases, we saw this yesterday, the dollar was selling off harder. And it does suggest that foreign buyers are the ones that are selling U.S. treasuries. It reawakens these concerns of something of a buyer's strike and then brings us right back around to focusing on the auctions.
What are they buying instead? Because it's not JGBs, it's not gilts. Not today, at least. This is a global story. We've gone back and forth on this already this morning. Yields are higher in the UK. They're up in Japan.
Yeah, they're up in Japan with the Prime Minister comparing themselves to Greece, which is always a bad situation if you find yourself in making that comparison. But at what point does it mean bad news for the Treasury market? George Savelos has made this argument of Deutsche Bank this morning that the real issue of higher JGB yields is one for the Treasury, because all of a sudden yields look more attractive at home and you're less likely to convert into dollars and to buy U.S. Treasuries.
The great repatriation that Peter Tchir was talking about a little bit earlier this morning. Busy morning already on the tax bill front. It looks like we're advancing that, coming to an agreement on the SALT deduction down in Washington, D.C. We'll catch up with Annmarie in about 10 minutes' time on that. Also need to talk about the retailers. Target in the pre-market is lower by 3.8%. Came out with earnings about an hour ago. The numbers, not great. The outlook cut, sales missed. The stock is down by 3.7%.
It seems like the market at the moment is treating this as just a Target problem, because we had earnings from Home Depot, from Lowe's, also from Walmart. Those looked fine, especially in the current quarter. Sure, you had some warnings about higher prices to come, but Target has a problem more internally. They need to change their strategy. .com doesn't look as good. They don't have as many groceries to save themselves if consumers are pulling back. They're talking about making a task force, unleashing cheaper goods that are under $1. So this might be a Target problem, at least for now.
In this economy, with this kind of policy backdrop, you need to be super agile, and Target's trying to do something about that. That name is lower in the pre-market. Stocks are recovering. The S&P's down by about 0.5% this morning. Coming up this hour, we'll catch up with Saira, Malik of Nuveen as markets face a reality check. Lindsey Piegza of Stifel on the Fed's commitment to a wait-and-see approach, and John Bilton of JP Morgan Asset Management with the outlook for bonds. We begin this hour with stocks lower after snapping a 6-day winning streak in yesterday's session. Saira, Malik of Nuveen writing, markets face a reality check due to two macro drivers: Moody's downgrade of US debt and continued tariff negotiations. Saira joins us now for more. Saira, good morning.
Good morning.
How important is that tax bill to this bond market?
I think it's very important to this bond market. What the bond market is worried about is that over the longer term, it will increase the deficit. And the bond market doesn't like that. And that's why we're seeing yields continue to back up. So we'll see where we end up on that. In the shorter term, though, the tax bill, of course, will be stimulative for the economy. So it's positive for the short term, not so positive for the long term.
Bond yields at these levels are not constraining the discussion, the debate down in Washington. When does it start to constrain this equity market?
I think at about 5% on the 10-year, equities will begin to get more nervous. Also, beyond the tariff issues and the Moody's downgrade, and downgrades of U.S. credit has generally not been positive for the markets, we have bubbling up geopolitical issues between Iran and Israel. So there's a lot of things for the markets to contend with, and I think that's why equities are experiencing a hangover this week.
Was there any signal in the fact that you got those bubbling up of tensions? The CNN report of Israel looking at a strike in Iran. And the only movement and change you really saw was in the oil price. We were still selling treasuries. We were still selling the dollar. Typically, you'd expect those types of assets to rally. What does that tell you?
I think it's telling me there is a little bit of this nervousness around the U.S. as a safe haven because of the tariff issues and the macro volatility that we've seen this year. So I think the dollar continues to be bearish in the longer term, not only because the U.S. economy is slowing, but because foreign investors are a little bit concerned about the strength of the dollar and the safe haven status. And then we're seeing the same thing with treasuries in terms of foreign buyers there. And that is becoming somewhat of an issue. It's been going on all year.
Can that extend to the equity market? Serena Tang over at Morgan Stanley wrote a note just moments ago, overweight on U.S. stocks, saying, still Tina. There is still no alternative. Is there an alternative to American stock markets?
Well, if you look at U.S. stocks will trade on the fundamentals. First quarter earnings very strong, coming in at about double the rate of expectations, 12% year-over-year earnings growth, about 3/4 of companies beating earnings. So earnings have been positive. And if you look at markets since they've recovered off the bottom, you've seen a lot of FOMO, a lot of intraday buying. So when you see these dips, retail investors are stepping back in to buy. Also, a lot of cash on the sidelines. People do tend to, unfortunately, sell at the wrong time and then chase their way back into the market. So I think there is still more buys to the upside for the U.S., led by technology stocks.
More buys, even though we are back at really lofty multiples. Sarah, I thought this was part of the problem to start the year, that we were just overexposed the U.S. Has that magically gone away?
I think the U.S. has fundamentally strong reasons for people wanting to be exposed to it. It's 30% of the S&P 500, actually over 30%, is technology related. If you look at historical earnings growth, about 2/3 of that has been driven by those tech earnings. We saw a very strong first quarter. The AI boom is alive and well. We heard that from companies like Microsoft this quarter. So I think the growth legs for the U.S. are still intact, in place. I totally agree with you. Markets are trading at a premium, but a lot of people want to get back into this U.S. market. And I think that plus the earnings growth gives it legs from here.
Your line, you just said it. The AI boom is alive and well. Several months ago, it didn't feel that way. The original disruption in 2025, DeepSeek. Have we overcome that?
I think we did. Yeah, I think DeepSeek was the big story of the year for about a month, and then we got into tariffs and everybody forgot about DeepSeek. It is something to watch. So the incremental spending on artificial intelligence and what's going to be the ROI on that, and also competing cheaper technologies like DeepSeek need to be watched. But what we've seen with these companies is demand for artificial intelligence, the productivity it can add to companies is very strong. And these dominant players like Microsoft that have spent tens of billions to get a leadership position, they're going to remain in place as a leader.
Have the winners changed? I think that is the ultimate question. Has anything changed post DeepSeek?
I think that the winners are going to continue to win, like Microsoft. Other areas that we like are software companies, which I think people wondered, what is AI going to do to software companies? I think for software, it makes them more productive. Also, it's showing traction in terms of capturing clients and cross-selling with clients. So that's why we like not only Microsoft, but companies like Veeva, which is a vertical industry software play in the life sciences industry. I think these are some of the winners over time. You need to be selective, but AI and the ones that have dominated it for many years are going to stay the leaders in the space.
I gotta say, it's remarkable looking at what's improved since the April nadir. First, you get the communication services, again, those kind of big AI names. Number two, and even before the info tech sector, is utilities. Again, a very AI-exposed kind of sector. Is that still the play? Again, post DeepSeek, the thought is that we won't need as much energy, that things have become more efficient. Can you still bet on the utility players?
I think you can, especially within the infrastructure space, which a big component of infrastructure is utility. So upgrading your grids because of the electrification of the economy, supply chains coming back to the United States, and the infrastructure that we need to build. Our utilities are going to be very necessary there. The energy needed for data centers, which will be more proliferate in the United States. All of that, I think, makes utilities continue to be a strong play and a nice AI derivative play.
So these are the sectors that haven't been downgrading their earnings as much. Where you have seen the downgrades comes from the more consumer-oriented sectors. You saw from Target earnings this morning some concern there in terms of demand. You hear Walmart talking about raising prices. Can you buy consumer-oriented stocks right now, or are things just too uncertain?
Consumer's been a tough space, but it did lead us out of the V-shaped recovery post the Liberation Day malaise that we saw. Soft data on the consumer is not strong. Outlooks from companies about the consumer were weak. We have not seen the impact of tariffs yet. History tells us we will see that about 3 to 4 months after tariff implementation. So it's very unclear, not only in terms of tariffs, who's going to eat them? Is it the consumer? Is it the producers? I think it's a combination of both. Margin expansion has been what has driven a lot of companies' earnings growth, though. So if companies are going to eat that cost of tariffs and margins get at risk, it is probably some downside for earnings growth going forward. Good news, we're at a high level, growing at 12% year over year. I think consumers going to be challenged from here, though. High-end consumer, low-end consumer, both areas could be challenged, but the tax cuts in that bill could be somewhat of a support for them, but it's not our top pick for a sector this year.
You mentioned the soft data, typically considered to be a leading indicator. Do you believe it's a leading indicator or a misleading indicator at the moment?
I think it's mixed because it's tough with the consumer. Consumers tend to be grumpy spenders. So when you see consumer spending, consumer sentiment weak, that's not necessarily a sign that consumers are going to pull back on their spending. We've seen a very resilient consumer during this cycle, already in a period of high inflation and high interest rates. And remember, pre the tariffs, inflation has been trending in the right direction. So if you add in about a 10% base tariff rate, that adds about 1% to inflation. Takes you back to about that 3% level. If the Fed sticks to their commitment to view tariff-driven inflation as transitory and they get the couple of rate cuts this year, we think we'll see 2, then maybe we can get through this and consumer remains okay.
If the Fed sticks to that view.
A lot of ifs there.
Any reason to believe they won't stick to that view?
I think it really depends if the tariffs and the inflation driven by tariffs is really transitory and if the underlying base rate of inflation continues to moderate as we've been seeing. So that's really, I think it's hard to say because all of this data from tariffs, we're not seeing it in the hard data yet. The economy looks pretty strong. Earnings have been strong.
I keep going back to this question. How will they know? How will they know the difference between what's short-lived and what's persistent? And how long is that going to take to find out?
Well, presumably it'll take a while to find out. If inflation is transitory, when do you see that? Do you not see it until next year? And then do you risk the scenario where the Fed is very reactionary and then they only start cutting when you actually look at the whites of the eyes of a labor market that's deteriorating? Are they too late then?
You mentioned Mike Gapen earlier from Morgan Stanley. No cuts for 2025. He believes they're going to have to wait that long, get to 26.
I think the Fed would run the risk of falling behind the curve if they wait for the employment market to crack. Looking at history, employment markets tend to crack at the beginning of a recession. That's going to be too late. I think they need to step in if inflation is trending in the right direction. Outside of tariffs, I think the Fed needs to step in and get that first cut going sometime this summer or in the latest fall.
Saira, you're going to stick with us. Saira Malik of Nuveen, staying with us around the table. Equity futures at the moment on the S&P 500. If you are just joining us, off session lows, but still lower by 0.6%. A lot of attention on the bond market at the moment. Yields are higher now by 6 basis points at a very long end of the curve. The 30-year maturity yields are up to 5.03%. There is an opening to advance this bill down in Washington, D.C. Speaker Johnson telling CNN earlier on this morning that it has been an agreement over the SALT deduction cap. We'll get you the latest in just a moment when we catch up with Annmarie down in Washington, D.C., alongside Tyler Kendall. For that and an update on news elsewhere, let's get your Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. House Speaker Mike Johnson says Republicans have reached an agreement on a $40,000 SALT deduction. Sources telling Bloomberg the deduction will phase out for annual incomes greater than $500,000. The deal looks to keep President Trump's big, beautiful bill on track in the House before heading to the Senate. Meanwhile, shares of United Health are tumbling in the pre-market, down 4.5%. The Guardian reporting the health insurer secretly paid nursing homes to reduce hospital transfers for sick residents as part of a series of cost-cutting tactics. United Health denied the accusations to The Guardian. And George Wendt, the actor best known for playing Norm on Cheers, has died. Wendt starred as Norm on every episode of the show's 11 seasons. He was nominated for an Emmy for Best Supporting Actor in a Comedy Series for 6 consecutive years from 1984 through 89. Wendt was 76 years old. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. More from Yahira later on this hour. Up next, the morning calls, plus Bloomberg's Annmarie and Tyler Kendall as Republicans strike a deal. From New York City this morning, good morning. This is Bloomberg. Live from New York City this morning. Good morning to you all. Your price action looks like this. Equity futures on the S&P about 1 hour and 14 minutes away from that opening bell. Equity futures are down by 0.6%. On the Nasdaq 100, we're down by 0.65. The nation's deficit and debt pile in focus once again this morning. In this bond market, yields are higher by 6 basis points. The 30-year, right now, Danny, the 30-year 5.03%.
I think it's going to be really notable to see if we can close here. And I think the notable thing will also be at what point does it affect equity markets? For now, most people we've spoken to, John, really separate out the two, that this is a bill that will be bad for bond markets, but good for equity markets because you don't want that tax hike. At what point does that not become the case? At what point are yields high enough that it finally starts to pressure equity markets?
A tax bill in Washington contributing to high yields in the US. A messy auction in Japan contributing to high yields in Japan, and hotter than expected inflation in the UK. Gilt yields are higher today by 7 basis points on 10s. On 30s, we're up by close to 8. This is truly global this morning.
It is, and I think it's notable because so many people have said, the Treasury market, we're going elsewhere, they're going at home. That's not happening right now. We're not fleeing to other markets, but the very fact that yields are higher abroad might mean that it's an inevitability, that you don't need to go into dollars, to Peter Schiff's point that in Japan, that is something difficult to do. You can stay in your own local currency and buy. So we might not be buying abroad this morning, but maybe at some point we'll get there if yields are higher.
Got a weaker dollar this morning once again, particularly against the euro. Euro dollar advancing by 0.4%, 113.28. That's some of the price action here in the morning calls. First up, Roth reiterating its neutral rating on target, seeing no reason to expect near-term improvement. That name is down after earnings by 4.7%. Your second call from Stifel upgrading Home Depot to buy, pointing to upside potential for its 2025 guidance. And finally, UBS raising its price target on Gap to 29, expecting their upcoming Q1 results to be a positive catalyst. That name is down in the pre-market by some 0.75%. Let's turn back to the nation's capital, to Washington, D.C., where House Republicans have struck a deal.
Can you walk us through where you think things are on SALT? Is this idea of 40,000 cap over 10 years the deal at this point?
That's the agreement we came to. And, I think the SALT caucus, as they call themselves, it's not everything they wanted, but I think they know what a huge improvement that is for their constituents, and it gives them a lot to go home and talk about.
Let's talk about it right now with Annmarie and Tyler Kendall. Annmarie, a breakthrough.
A breakthrough, momentum really for Speaker Johnson to potentially get this bill, not just through the Rules Committee this morning, but onto the House floor, Jonathan, today or tomorrow. So that would meet his self-imposed deadline of Memorial Day. We should note Congress really does start to act when they have a holiday on the horizon. But the speaker there, quickly caught by CNN on his way back into the Capitol, talking about the fact that this is the agreement in place. So they would be raising the $10,000 SALT and state local tax deduction, the cap, to $40,000. That seems at the moment potentially that will get the SALT caucus on board. Representative Lawler was speaking to NPR earlier this morning, and he talked about the fact that they're still working through some of the finer points. We should note, though, for Speaker Johnson, while this is, yes, huge momentum forward, this might be the easiest week he has when it comes to the one big, beautiful bill, because then it's going to go to the Senate. And Majority Leader Thune recently told Punchbowl News that he thought $40,000 was very generous. What is the impetus for any of these senators, especially given the fact that, look at the Republican senators the New York senators are Democrats. So you're not going to have that same kind of push in the Senate to keep maybe this $40,000 cap. I think, as Terry Haines has talked about, this is really the high watermark when it comes to SALT.
And Tyler, let's just build on that. Let's talk about the process. This is just the end of the beginning. How much harder does it get from here?
Right, exactly, John. I mean, that is going to be an uphill battle once it does head over to the Senate. House Speaker Mike Johnson made his way over to the upper chamber in a pretty unusual move yesterday to try to start to talk to these lawmakers about not really changing what is happening on the House side. But we do know that many of them already have some proposed changes, including when it comes to anything touching Medicaid. Now, we are expecting House Speaker Mike Johnson to also give a call here to the White House later this morning, because keep in mind, any of these changes do also have to get the stamp from President Trump, who made his way over to the Hill yesterday and really downplayed the idea that they were going to lift the SALT cap. A senior administration official tells us that the message inside the room to these Republicans from high tax states was pass the bill now as it is, accept that $30,000 cap that had been on the table, and then you could potentially amend the tax rate going forward. But it is clear that these Republicans really did dig in and really saw this as a political opportunity that might not come around so often, considering it's been a priority really since 2017 when that cap went into place.
Annmarie, before you go, timeline, self-imposed deadline, Memorial Day to get this through the House. When is this signed, sealed, delivered on the president's desk?
Honestly, Jonathan, it really depends who you ask. If it's up to the president, it would be next week, right? But of course, then the Senate is going to tweak all of this. SALT is just one aspect of these edits we're going to see through the Rules Committee when it comes to those amendments. We're still waiting for that text. Then there's things like the Inflation Reduction Act, the Biden-era tax credits for clean energy incentives. There is reporting that that was supposed to be rescinded, potentially rolling some of those back after 2028. But for Speaker Johnson, dealing with some conservatives and some individuals who don't want to see those credits continue, that actually might start by 2028. But then it goes to the Senate, and you have senators who say we have all these small businesses that work towards this. So it's going to be weeks. Terry Haines says July 4th. There's an 80% chance. Some other people I talked to said potentially August. Remember, the debt ceiling is also going to be part of this. So they're going to have that X date they need to contend with.
They've got some work to do this summer, that's for sure. Annmarie, Tyler, to the two of you, thank you. Saira, Malik of Nuveen is still with us. Saira, fiscal stimulus is good for markets. Fiscal recklessness is not. We've been asking this question all week on this programme. Do you think this is fiscal stimulus or fiscal recklessness?
Well, the answer is it could be both, depending on your time frame. Shorter term, fiscal stimulus. Longer term, your risk is that if you can continue to increase this deficit and we go into a recession, the deficit as a percent of GDP will basically blow out because tax receipts will be down significantly when you're in a recession. So that's the question for the markets. Do you want to focus on the shorter term or the longer term? I think right now markets are focused on the shorter term. They're saying earnings growth is in the double digits. Hard economic data looks fine. We like the stimulus that's coming to the markets. Equities like that.
What is the mechanism for us to concentrate on the longer term? What changes need to happen? What do we need to see that makes us concerned about rising deficits and the potential recklessness of it?
I think bond markets are the ones that are giving you the yellow flag and saying, something perhaps isn't right here over the longer term. I think the equity markets will pay attention if yields continue to rise. If borrowing becomes even much more expensive, we're living in a period of higher for longer inflation and interest rates, equities will become more nervous. So it's the degree of the rate of change in yields that's going to impact equity markets. But we're not seeing that yet at this point. I mean, this deficit has been something I feel like we've discussed for so long. It's been an issue for years. And really, equities have somewhat ignored it. And I don't think that can go on forever. But at this point, I think we need to see a little more damage done by the bond markets before it becomes front and center for equities.
Is it also then distracting for what has been the concern for the equity market until very recently, which is tariffs? Sure, you have 90-day pauses going on all around, but tariff rates are still set to be much higher. Are we getting distracted by taxes right now? Does the equity market at some point come around to the concerns of the damage done by higher prices coming in for importers?
I mean, taxes are definitely the story of right now, but in a couple of months, we're going to see the impact on the economy from tariffs. If you look at that baseline of about 10% tariffs for the rest of the world, you actually skirt a recession. It impacts GDP by about 1.5%, and you don't go into a deep recession. Of course, a lot of variability around these numbers and the level of tariffs that we eventually end up with. But I think the markets right now are saying we have a little bit of visibility on where tariffs might end up and what that might do for the economy. And we have some reassurances from the Fed in terms of how they're going to think about tariffs. And that's what markets are counting on. It's a fine line. It's a tightrope that they're walking in this sense with premium multiples. But I do think that U.S. tech is where the earnings growth is. That's what can continue to lead. But let's not forget the other surprise of the year, which is international markets. I don't think anyone expected them to outperform U.S. markets to the degree that they have.
European banks to start the year, just absolutely phenomenal. Saira, Malik of Nuveen. Saira, good to see you.
Yeah, good to see you.
As always, appreciate it. Great to have you here with us in New York City. Let's talk about that data. The bad news. This is a show me market. Show me the bad data, because we haven't really seen much hard data that's come in quite badly.
You haven't. The inflation data has been really benign. The only place you see it is in the soft data. And you can just say, hey, something like a University of Michigan study is so polarized, depending on whether you're a Democrat or Republican. Maybe once the hard data starts getting bad, we can also say, it's all distorted. So a lot to ignore, I guess.
Depending on where you live and who you voted for, I think dictates how you feel about the economy.
I think that's exactly right.
According to the University of Michigan. According to them. Up next on the programme, Lindsey Piegza of Stifel, John Bilton of JP Morgan Asset Management, live from New York. This is Bloomberg. The opening bell about 60 minutes away. Equity futures doing okay. We're negative by about 0.5%. On the S&P, some notable movers in retail. We'll get to a few of them in just a moment. Let's get you some morning movers. Let's do that with Yahira. Hey, Yahira.
Hi, John. We start with Target. Those shares are now falling 5.7%. The retailer cut its full-year sales outlook after a weak quarter, saying that customers are not going into its stores as much and spending less. And they're pinning the blame on weak consumer sentiment due to tariffs. But it's also that unlike its competitors, its product mix is more discretionary. So it doesn't have the essentials like groceries to lean on in the same way that a Walmart does. Next up, we have VF Corp, and this is the company behind Vans and Timberland. The stock is plunging 12% after it warned of a bigger loss and said that it's fast-tracking shipments amid Trump's 90-day tariff pause. But that rush could raise costs, so it's warning that it will need to raise prices on its items. And last up, we have United Health. It is falling 4% here on a report by The Guardian saying that the insurer secretly paid nursing homes to limit hospital transfers even when residents needed urgent care. United Health has denied the accusations, but this just adds to the worries about this company, as the Wall Street Journal recently reported that it was under criminal investigation by the Justice Department. John?
The hits keep coming for that company. Yahara, thank you. Thank you very much. On the earnings front, the more earnings we get, the more confused I become. There's no clean read on anything right now.
Well, even in the same sector, you can't get a clean read. Yahira was talking about Target. You can't even quite understand what the consumer is doing because someone like a Home Depot says things are still strong. Yeah, not spending on big projects, but spending on small. And then Target comes out and says, demand is bad across the board. So you can't even look at just consumer stocks and get a clean read.
Which is why this Fed is not in a rush to do anything. The San Francisco Fed President Mary Daly, Cleveland Fed President Beth Hammack, emphasizing the Fed's commitment to a wait-and-see approach while navigating so-called uncertainty. Mike McKee, our economics and policy correspondent, joins us now for more. Mike, you've been at the Atlanta Fed conference over the last couple of days. What's the standout feedback you're hearing from Fed officials and others?
Well, I think that, excuse me, the biggest thing, John, is that market participants and Fed officials are looking at this in different ways. Market participants, as one person put it to me, we need something solid to hang a recommendation on. And so they're looking at the data, and so far the data has been reasonable, and they're more optimistic. The Fed officials are saying the data can't be trusted. It's too far behind. I sat next to one Fed president last night at dinner who said the beige book is stale by the time we get it. So what they're doing is continuously talking and having their staffs continuously talk to business leaders about what they're thinking at that moment and what the plan might be for that company. Because as Raphael Bostic put it last night, they have to make a decision at some point about whether they're going to hire, fire, raise prices, keep prices unchanged, expand or not expand. And if they're going to expand, how much are they going to spend? All of that. And right now they're frozen. At some point, they will have to make a decision. And what his worry is, with this uncertainty continuing, they will just decide not to do anything. They will sit as long as they can with their employees, raise prices to the extent that they can, but not invest in the economy. And that will keep us from growing.
Mike, New York Fed President John Williams mentioned September. Is that the point on the calendar that you've got circled now?
That would be the first point. I think all of them are pretty much in agreement that we're not going to have enough information to have these companies make decisions until we get to the end of the summer, because not only do you have the question you were asking earlier about when does the budget bill get passed, but you also have these various 90-day extensions and whatever deals are being negotiated or agreements are being negotiated. And nobody really has any idea when any of this is going to hit the economy. So just looking at, Annmarie said it could be August before the budget bill. So the Fed's not going to have that as an input until then. They're going to look to the fall before they would do anything. But again, they all say the same thing. We are well positioned right now. We're kind of in the middle. The economy is okay based on our rate setting. And so we'll just leave it there.
Mike McKee with the latest. Mike, I've enjoyed the reporting through the week so far. Thank you, sir. To extend the conversation, Lindsey Piegza of Stifel joins us now for more. Lindsey, this is the dilemma they're confronting right now. The policy shock, the volatility of the last month or so could tap the brakes on the US economy, maybe even slam the brakes on the US economy. And then you've got a tax bill going through Washington, which might provide some additional stimulus in 26. If you're the Fed, what do you do?
Well, I think the Fed's been very clear that right now they are waiting for further clarity, justifying this position on the sideline now for the third consecutive meeting. But I do think that the Fed is facing a very narrow window of opportunity. Now, I want to be clear. I'm certainly not advocating for the Fed to cut rates, but playing devil's advocate and putting myself in the shoes of a more dovish-leaning Fed, if the Fed was looking to move policy further into neutral territory, now is the time to take action against the backdrop of weaker growth in the first quarter and decelerating inflation. But should the Fed remain on the sideline for much longer, looking out to the second half of the year, I do expect inflation to regain some momentum, as well as the underlying economy regain some momentum. And that's going to shift the conversation away from the potential for rate cuts back to not necessarily just neutrality, but potentially further rate hikes as we look out to that inflationary impact impact of presumably a settled deal on tariffs around.
Lindsey, wouldn't that be a problem for the Fed, though? If they were to cut now and then you get something that looks like a reacceleration of inflation, do we not get back to conversations that we've had in past years, that they acted too quickly and that inflation needs to be their concentration?
Well, again, we would simply just perpetuate the conversation we're already having. When we look back to the end of last year, that 50 basis point cut out of the gate, followed by 2 consecutive 25 basis point cuts, looking in hindsight, was very unjustified. It was motivated by potential weakness in the labor market, which never materialized. But again, just looking at this from a dovish position, which the Fed does seem to be desperate to provide additional relief to an ailing economy as we look at that first quarter negative GDP print. But you're right. I don't think the Fed should be talking about rate relief as the level of inflation still remains nominally elevated, well above that 2% target.
Well, there have been some who have pointed out some bubbling of weakness in the labor market, maybe not on the headline statistics, but in things in terms of hiring rates, in terms of how many people are being fired. Lindsey, is there still a risk there? Is the labor market still under pressure right now?
Oh, I think the risk is absolutely to both sides of the Fed's dual mandate. And to your point, we have seen not necessarily weakness, but that second derivative decline, a cooling in momentum in terms of top-line hiring. We've also seen some cooling in terms of wages and a modest uptick in the jobless rate. So there are some indications that the labor market is starting to cool, is starting to come under pressure. But when we look at that juxtaposed to still a near 3% inflation rate, I think the Fed's focus should be on reinstating price stability, a goal that they failed to achieve the first time around with rate hikes ceasing at 5.5%.
Lindsey, we spoke to Bill Dudley, the former New York Fed president, a little bit earlier on this morning, about 50 minutes ago. And he made the case that he doesn't think the Fed is doing a good enough job of articulating its reaction function. And when we asked him, what should the Fed do? If the dual mandate is in conflict at the end of the year, what should they prioritize? He didn't really know. Can you give us some advice? What should they do?
Oh, I think the Fed, first and foremost, needs to focus on reinstating price stability. In fact, again, I do think it's a sizable disappointment that the Fed did not reach a sufficiently restrictive level the first time around to get us back to that 2% price level. So we've already been contending with elevated price pressures that the Fed failed to quell even before the Trump administration stepped into Washington. Now you layer on the uncertainty of tariffs, and that simply compounds the upside risks to price pressures. And while employment may slow somewhat further if the economy does remain tepid under the pressure of these changes in international policy, on the inflation front, the economy does not work for anyone if we cannot get back to a period of price stability.
Lindsey, just finally to jump in,
the Fed needs to prioritize that.
When you think about the sources of inflation, what is the persistent source of inflation that you're most concerned about?
Well, we've seen inflation become very ingrained over the past couple of years, particularly in the service sector, as we see these lingering repercussions from the aftermath, from the easy policy in the aftermath of the pandemic. And that has become well ingrained, well entrenched in the economy. And it's going to become increasingly more difficult for the Fed to get that out of the economy the longer they remain at these relatively benign levels of rates.
Lindsey Piegza of Stifel. Lindsey, one of the best. Always enjoy your commentary. As always, the latest on the economy. Let's get the latest on this market. John Bilton of JP Morgan Asset Management, over from London here in New York. John, it's good to see you.
You too.
Thanks for catching up with us. I want to talk about this bond market and what we're seeing take place. Yields are higher not just in the US, seeing it in the UK, seeing it in Japan. Had this question from a Bloomberg Terminal subscriber earlier this morning. What's the more relevant driver of bond yields now? Domestic considerations like the Fed, fiscal legislation making its way through Congress, or what's happening globally?
Well, I think it's a bit of both. I think you've got to break it apart because what we've seen with the debate going on through Congress and the passage of the bill, plus the tariff impact, there's definitely an inflationary issue that's sitting here facing the US. Whether it's price level or more persistent, time will tell. We think price level. We actually take it to a more global footprint and think about what's going on. The US is wanting to buy fewer goods from other countries. You leave a supply overhang. You end up with a disinflationary impulse. So actually, if we look at it globally, it's quite interesting. We're beginning to see a bit of a bifurcation. So we favour markets Australia, parts of Europe, even Italy, etc., as places where we could be quite willing to lean into duration, lean into bonds. The US, we are seeing a little bit of volatility, obviously, in terms of the market testing the upper end of what we think is the fair range for yields. We've seen it bounce off a 450 kind of range before, but of course we're now calibrating, well, the market is calibrating what it means as this bill passes through for the overall long-term supply of bonds in the market.
Stimulus or recklessness?
Yes, I know you've asked that question a few times
it's on
before.
repeat. What do you think?
There you go. I think it's right to look at it in terms of actually its sequencing. I think the stimulus short term, but let's put a caveat on this. What's the bill trying to do? Ultimately, it's trying to stoke domestic investment. Look into the detail. These things really always require scrutiny of the detail. One of the important things when we look at the market is the capitalisation of R&D expense. And you look at the sectors which potentially that affects most of all, the auto sector, parts of technology, parts of consumer discretionary. And essentially what it's saying is if you're willing to build productive assets which potentially can add to the potential growth of the US economy longer term, then you're going to get a little bit more of a benefit from the tax code here. So when you look at it from that basis, there is certainly a plan in place. So yes, stimulus near term, but it is very much with the ideal that if this investment is done properly, potentially it could push up that growth rate longer term as well.
So you have a growth rate that's pushed up longer term. I got to say, everything you're saying sounds corporate America is still going to be healthy, regardless of what happens in the bond market. You can still move your money here for equities and for credit risk. Is that the case then?
Well, I think we've got to work out what's going on here. So we've seen a lot over recent weeks about this whole idea. Is US exceptionalism over? Is it time to sell America? We don't agree with that. But what we do think is that we're repricing the premium. There's a little bit more uncertainty. If you think about the US is trying to shrink its current account. When it shrinks its current account, its capital account's going to go down. By definition, a little bit less demand at the margin for US assets. So what does that mean? You've either got to see that demand go elsewhere, or you've got to see the premium increase to get those buyers back in. So if we look at the US base, actually, you look at some of the best opportunities out there, continue to be in some of the big winners in technology, where these big investments are happening. So actually, it's a big kicker to some of those early winners. But what is happening globally is investors are saying, can I get some exposure to diversify away from this core, as opposed to saying, you know what, it's time to go out and sell it?
Well, Peter Tchir was with us earlier and made the argument that if you want diversity, it is the U.S. market, where 40% of earnings come from abroad, that no other local market will give you that kind of access. Does the very structure of the American market mean that it doesn't even matter if U.S. exceptionalism is waning, that this is a global market, and in order to capture that, you need to be invested in something like the S&P 500, in something like American credit?
I think that makes sense to some degree. But what I will say is it misses a small point, which is that we're seeing responses internationally to some of the issues that are coming here. It's worth thinking about it. I mean, the speech in Munich from J.D. Vance upset Europeans, but it maybe did more for European unity than anything since Mario Draghi saying we'll do whatever it takes to save the euro, because what it's done is galvanise views in the local market. It's prompted a relook at things like defence spending, fiscal packages, which have come through very significantly. If you want exposure to those kind of trends, which are longer run trends, chances are you're looking to have some exposure to those local markets. So yes, while we agree that it's an extremely well diversified market and there is a good reason to have US as a core of any equity investment, there are opportunities that are cheaper and geared to some interesting local patterns that can be picked up with international diversification. And we're seeing that come through, I think, in equity market performance over the course of this year.
When you speak to clients, can you just compare and contrast what conversations used to sound like in Europe and the United States to what they sound like now? How much has changed?
It really quite a lot. It's one of those interesting things. I always think that Europe performs when no one's watching it. And I remember going around in November last year, meeting clients and talking about Europe, saying, it's kind of cheap and, we think we could at some stage get some fiscal stimulus. Goodness me, it happened quickly. And a lot of them were saying, not really that keen. Is it ever going to grow? Is it just dead money? All of a sudden now, European investors have rediscovered their region. It's rediscovered a little bit of va-va-voom, which I think is really important. Now, does it have the same depth of market, the same sort of ability to have diversification across sectors as the US? No, it doesn't. But does it have opportunities to gear into a region that's got much better sort of fiscal outlook, much more fiscal space, and has got also the capacity to see rates fall some? I think the answer there is yes.
What they do with the money, though, is important, and maybe we should finish there. When you talked about the US tax code, you were talking about building out the supply side of the US economy, which over the long term should provide a boost to the US economy.
Correct.
What I hear in Europe is defence spending. I just wonder how enduring the growth hit, the growth pickup you could get from this kind of spending we're talking about in Europe.
Yeah, I think that is a particular issue. But bear in mind, while a lot's being made of defence, because Europe has committed to coming up to the NATO thresholds on a lot of that, there's also a lot of work being done in a number of areas, whether it be infrastructure and transportation, shifting away from sort of older sources of energy to newer sources of energy, whether that's different supply chain in conventional or moving towards renewables. All of these are areas which can create technological breakthroughs, but more importantly, create good quality jobs. And I think that's really the key within Europe. So at the margin, I think look at the wider slate of spending that's taken place rather than just the defence angle.
John, appreciate the update. As
My
always,
pleasure.
great to see you. Great to see you again. John Bilton there of JP Morgan Asset Management. Your equity market at the moment, just a little bit softer on the S&P 500. Keeping an eye on what's happening in the bond market, particularly at the long end of the curve on a 30-year yield, just hanging out around that 5% level. Let's see if we can close at those levels later on this afternoon. With an update on stories elsewhere this morning, let's get you an update, your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. We start with the breakthrough on Capitol Hill. House Speaker Mike Johnson says Republicans have reached an agreement on a $40,000 SALT deduction. Sources telling Bloomberg the deduction will phase out for annual incomes greater than $500,000. The deal looks to keep President Trump's big, beautiful bill on track in the House, with the floor vote expected later today before heading to the Senate. Meanwhile, the U.S.-China tariff truce triggered a sharp rebound in trade activity. Container bookings to the U.S. more than doubled in the week beginning May 12th, and shipping rates from Shanghai to L.A. jumped by the most this year. Prices for space on ships across the Pacific into the U.S. also rose. Spot rates from Shanghai to Los Angeles jumping about 16%. And the Oklahoma City Thunder beat the Minnesota Timberwolves in Game 1 of the NBA's Western Conference Finals. The Thunder defense held the Wolves to just 40 points in the second half. Tonight in the East, the New York Knicks play the Indiana Pacers. And in hockey, the defending champion Florida Panthers are up 1-0 in the East Final after beating Carolina 5-2 on the road. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. We'll head down to Washington and catch up with Annmarie as the president's one big, beautiful tax bill makes some progress in the nation's capital. The opening bow some 38 minutes away, with equity futures pulling back by 0.7% on the S&P. Similar move on the Nasdaq, worse move on the Russell, negative there by 1.2%. Around the table, we've been focused on one thing really, developments in the bond market. 30-year bond yield higher again, back through 5%, up 5 basis points, 5.02%. It's not just the US, it's Japan, it's the UK. Danny, it's been a global move over the last few days.
It has been a global move, which is notable because so many people have said there's a buyer's strike in the US and you're going to go abroad. The question needs to be asked, where do you go abroad? You certainly can't go to Japan, where they had a really messy auction. You had the premier there comparing it to Greece, which is always a bad sign. You have inflation that's higher in the UK. Bond yields chart higher. So where do you go? You might still only be left with there is no alternative to American markets.
I think John Bilton said Europe and Australia, places that might face the disinflationary shock off the back of the US putting the walls up for trade.
Yes, and okay, you could also make the argument that if yields are going higher, at some point they'll calm down and you don't need to go to the US. But I think for all of that, the auctions will be really important. A 20-year today, we can debate how important that really is. Next week, it's 2s, 5s, and 7s. That might really be the tell as to whether we're having something of a buyer's strike, especially as the budget percolates through DC.
Looking ahead to that auction this afternoon, here is your trading diary. The Canada looks like this. Before we get to 1 p.m. and that 20-year bond auction, at 11:30, President Trump meeting with the president of South Africa. On Thursday, PMI data plus another round of jobless claims. On Monday, remember the long weekend, US markets closed for Memorial Day and the self-imposed deadline for House Republicans to pass President Trump's tax bill to the Senate. Joining us now, Annmarie in the nation's capital. And Annmarie, on track maybe for Monday?
On track, maybe, Jonathan. But of course, this has really been challenging for Speaker Johnson. It feels like one step forward, maybe two steps back. There is momentum. He said there's an agreement when it comes to the SALT caucus, raising the $10,000 cap to $40,000. But just moments ago, Jonathan, we heard from Congressman Chip Roy of Texas, part of the Freedom Caucus. He's on the Rules Committee, which right now the Rules Committee is having their hearings regarding this bill. We are still waiting for the text of these amendments. And Chip Roy, his message, still a no on the tax bill. So potentially Speaker Johnson has more work to do today before the full bill hits the floor.
Yeah, this is not the beginning of the end. It might be the end of the beginning. There's a lot of work to do down in Washington, D.C. Annmarie, before you go, before we get that auction later on this afternoon to talk about debt and what it means going forward from here, 11:30, the president meeting with the South African leader. How contentious is that meeting going to be?
I mean, it's going to be incredibly contentious, given the fact as well that you have the South African leader here coming to try to face the president to discuss a number of issues that the president has taken aim at when it comes to South Africa regarding things like immigration as well. Jonathan, of course, we have that news about Starlink. Potentially, this was an olive branch to Trump world. I would also note that we know the president doesn't have plans at the moment to attend the G20 in South Africa. Could potentially the South African president change his mind?
Annmarie, do we know if Elon Musk is attending that meeting?
We do know that Elon Musk said he will be having dinner with the president tonight, and he'll be meeting with the South African president today. So likely that will be when President Trump is also meeting with him.
Interesting. Looking forward to the outcome of all of that. Annmarie, appreciate the work. As always, great work down in Washington as this bill seems to be advancing down on Capitol Hill, making some progress on the SALT deduction cap. But then, beyond that, there's a lot of work to do.
There's so much work to do. I mean, that's not even to say for what happens in the Senate and what happens with the deficit hawks. You know, you mentioned Elon Musk. I can't wonder if this is coloring some of it. Elon Musk saying that he's going to be spending less when it comes to politics. I think there are a lot of people frightened in Washington, D.C., that if they didn't fall into line, they could get primaried by someone backed by Elon Musk's money. If that's not a threat anymore, does it allow more lawmakers to be more bold and to push back because they're not going to have that headwind anymore?
Especially those that face that re-election risk in the not too distant future. Danny, thanks for this morning.
Thanks for having me.
And happy birthday.
Oh, thank you very much.
Massive happy birthday to Danny Berger. A big thanks for this morning. The wonderful Danny. Birthday wishes from us all.
It's okay. We can ignore my birthday. I hate celebrating it.
But
thank you. Thank you for it.
We're going to
anyway.
celebrate it in a commercial break, OK? Coming up tomorrow, Seema Shah of Principal Asset Management, Sam Zeeth of JP Morgan, Alicia Levine of BNY, Scott Kroner of Citi. From New York City to all of you around the world, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.